All right. Good morning, everybody. Good morning, Miss Debbie, Josh, Sydney. Nice to see you guys. How's everyone doing today? Welcome back. Hope you had an awesome Christmas. Or if Christmas isn't your thing, I hope you enjoyed the day off. Whatever. Hey, Dwight, how are you, man? Guys, what is today? Today is Wednesday. I've lost track of the days. It's always a wonderful problem this time of year. Good morning, David. But I believe today is Wednesday, December 27th. And every morning I'm checking for news, right? Good morning, Jim. Nice to see you. Both of the Jims. Um, First thing I do every morning, guys, I'm sipping coffee. I'm done reviewing my trades from yesterday, and I'm checking news. I'm going to forexfactory.com/calendar, and I'm like, hey, who's going to say something? What are they going to say? What's the impact going to be? There's two impacts. Good morning, JW, that I'm really looking for. I'm looking for these medium impacts, these orange boxes. And that's what we have today at 10 a.m., the Richmond Manufacturer Index. It may or may not move the market. It may or may not create a spike. I don't know, but it's medium impact, which means that it has the potential to. So for my money, I'm a sit on the sidelines kind of guy. I prefer to not jump in front of a reaction at news. I'm also looking for high impact. Those would be a red box. We don't have any this week. It's a pretty mellow week as far as trading goes. Hey, Cav. If you watched the market yesterday, I thought there was a lot of great opportunities. You just had to be patient and wait for them. Over the course of 6 or 7 hours, I think just walking back and forth inside of my office, I took maybe 4 or 5 trades all day yesterday, but they were good. They fit the rules. So yesterday was a nice day. So we're going to do the same thing today, guys. We're going to talk about the rules and everything, but I always check news. I just want to make sure that I'm not getting in front of something that may be happening. And then what else? I'm excited to be back. I'm a little coffeeed up. Gonna have a good one. Everything that I talk about, guys, I mean everything. Like anything and everything that you could ever hope to be successful with comes right from the tutorial section of the education page. I try not to keep anything from you, but I do also try to keep it very simple, guys. I'm trying to keep everybody focused in the beginning. And if I have any new people in here, let me explain how the classroom works typically. Your first hour, our first hour together, it does lean towards lecture, guys. We talk very much about rules in the first hour. And we're going to talk about a high probability trend trade. That's really going to be my focus for about 60 minutes, 45 minutes. And we're going to talk about a trade where each indicator on every chart agrees for the rules for the trade. This is a trade that typically wins 70 to 80% of the time when you follow the rules. This is a trade that creates an awful lot of confidence. It's easier to learn. It becomes easier to manage because of all the advantages present. And this is really your foundation trade, guys. So I try to lay that foundation in the first hour. Your second hour, your third hour is your opportunity for a private session, really. All you have to do is drop a picture in the room. All you have to do is say, hey, Mark, here's my trade. Or, hey, Mark, here's a picture of the read that I'm struggling with. Let's talk about it. And we will. And we'll spend as much time as we need to get you clarity. So maybe little lecture in the first part, then very much discussion in the second part. Hey, good morning, Lyle. And then I want to remind you guys, I know everybody's got different schedules, different lives going on. If you're like, man, I'm not going to be here in the second hour, I'm not going to be here in the third hour, but I really need some feedback, just let me know. Just type it in the room. Hey, Mark, I've got to go work. That dreaded 4-letter word. Will you do me a favor and review my chart? And I'll say, absolutely, I will, and we'll make that happen. But this high probability trend trade, guys, this is our focus. This is the best of the best. This is the one that's going to turn you into a chart reader. There it is. And chart reading is about 90% of your day. And if you don't believe me, maybe you were watching the NASDAQ this morning. If you're a NASDAQ trader, and guys, it was a range-bound market. My entire morning was spent watching this market consolidate. My entire morning was watching the market stuck in this range, and I never had any rules met. I never had a clear path or momentum. So I did nothing. I did absolutely nothing because my rules weren't met. And that's one of the hardest things that you're ever going to do as a day trader is absolutely nothing. But 90% of your day is going to be spent looking for advantages, whether it's a high probability trend trade or a medium probability trend trade. But you're going to walk away from this class and these classes with a very solid plan, a very precise set of rules for what it's going to take to get you into the market. Because when you spend a little time with the high probability trend trade, when you begin to learn to become a chart reader, you're going to understand these three real key concepts. You're going to understand where the market is likely to continue, and that becomes an entry point for a high probability trend trade. You're going to understand where it's likely to go, which is going to help you make intelligent choices on profits. And then you're going to understand where it's likely to stop, where that trend is likely to end, where the market has the potential to reverse. And when you understand that, guys, there's so much power in it because not only will it keep you from trading into an area that may shut things down, but when the market does reverse from one of these areas, when we put in what we call a good top or bottom, man, it just sets you up for so many opportunities going the other direction. So if you commit initially, keep it simple. And that's what we're going to do is we're going to focus on a high probability trend trade. We're going to focus on a trade that only has three rules. You're going to be, what's the word I'm looking for? You're going to want to create more rules for it. You're going to want to create more scenarios because you think that the more rules you have, the better your chances of success become. But these three simple rules, guys, they give three advantages that create a trade. And the advantages are in yellow here. The three rules: strong triggers on your large chart, nothing in the way on your large chart, and then using a simple rule for entry on a small chart provides you the advantage of momentum, a clear path, and an entry area. And when you have these three advantages, well, that's a trade. That's a high probability trend trade. That's a trade that typically wins 70 to 80% of the time. And honestly, that's a trade that builds this foundation that sets you up to catch all the other trades. These three rules, let me drop them in the room for you. These three rules are going to come to be on only two charts. And I think that's pretty amazing because you're not burdening yourself with 3, 4, 5 charts. You're not burdening yourself with trying to figure out 7, 8, 9, 10 things in order to pull the trigger. You're saying, man, I've got momentum, I've got a clear path, I've got an entry area, let's go. And the large chart leads the way for us. The large chart really sets the tone. It tells you what the market is doing. I always say large chart represents what the large crowd wants. The people that move the market are represented in this large chart, and it will define direction, it'll define momentum, and it'll define areas. And your first two rules, your first two advantages come to be on that large chart. And if you embrace it, if you embrace the simplicity, every time you take a trade, you're going to have the advantage of momentum. You're going to have the advantage of a clear path. And the large chart's this broad stroke. It's one bar, really. It's a one bar affair. The most current bar defines that direction, momentum, and areas. Your first two rules are met from the first bar on the large chart. And when they're true, that's when we kind of whittle it down to an entry. That's where rule number 3 is going to get you into that most likely to continue point. And it just refines the broad stroke of a brush. What happens on this one bar on the large chart can be broken down into 15 to 30. Hey, good morning, Chris. Dude, it was awesome. How was baby's first Christmas? Did she get a million toys that she'll never play with, I hope? That's usually how it works. Guys, we're going to take this broad stroke of a brush. We're going to drop it down into 15 to 30 bars. And you're really going to be able to pinpoint where the market is likely to continue. And it's really pretty outstanding because it allows you to reduce your risk and it allows you to increase your profit potential. And that's rule number 3. So just 2 charts, 3 rules. We're going to let the large chart lead the way because it's what the large crowd wants. We're going to let the large chart define direction, area, momentum, get those first 2 rules met. And then we're going to let the small crowd, that little group that fights everything, push us right back to our best of the best entry on a smaller, faster chart. So that's going to be our focus today, guys. We're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. You guys get to simulate. It's a lot of fun. It's like video poker, right? You get to go in and enter trades and make pretend profits and take and learn to accept pretend losses. But what you're really doing is you're practicing. You're practicing the rules. You're practicing to get in at the right moment. You're practicing to get out at the right moment. And you're creating muscle memory for when it's time for you to go live. So simulate, but simulate the correct rules. And there's no reason for you to understand whether or not you're trading the correct rules as a new user. So that's where posting in the room, right? Post pictures in the class until you're sure, until you're sure that you're giving yourself these advantages. We don't want you practicing the wrong trades because these getting lucky victories feel good in the moment, but they're rarely a long-term path to success. They're really more of a long-term path to failure. So stay focused on the rules, but be willing to make mistakes, right? Give yourself a little bit of grace. We're going to simplify heavily. We're going to look at that high probability trend trade. I'm also going to introduce you to a medium probability trend trade. And medium probability trades are defined as a trade where almost all of the indicators line up for the trade. However, a small issue exists. And that issue is singular. That small issue exists. And typically, and in your for the brand new user, I'm going to give you a plan to take a medium probability trade where the path maybe isn't as clear as we'd like it to be for high probability. And you're going to be able to use your chart reading to define that. You're going to be able to use your chart reading to make sure that you're not sacrificing momentum or an entry area. But we're only going to talk about 2 trades initially. You can post any trades you want. Good morning, PFI. Nice to see you. But what looks are you going to commit to, right? That's it right there. What look is solid enough for me to risk my money? What look has been proven to win more than it loses? Because that's the look that I want to risk my money on. What look has a statistical advantage, has been proven, is testable, is repeatable? Guys, that's the high probability trend trade. That's what we're looking for. But you've got to get to the point to where you recognize it in the moment so that you can really capitalize on the advantages. And you're going to do that 2 ways. And this is the step-by-step path to becoming a confident trader ASAP. The first one, post your trades in class, guys. Tell me why you did what you did. And people are always hesitant to do this because what if I'm wrong, right? I want you to be wrong. Good morning, Jose. As you're a brand new user, you'll learn more from making mistakes than you ever will just taking one perfect trade every time. It's kind of like knowing what you're up against. So tell me why you did what you did, even if you're not sure about the rules. Just go, hey, everything was green, Mark, so I hopped in here. And we'll talk about advantages. We'll talk about everything. Give me 1 second, PFI. And there are no wrong answers, guys. There are 0 wrong answers on your chart. The best thing that you can do is put it on there, and if something needs cleaning up, we'll clean it up. Show me where you entered. Entries come, PFI, this is for you. Entries come from areas inside of favorable large triggers. And sometimes they're below fibs, especially if you're on a 50-50, right? But show me where you entered. Talk about it. And PFI, if you want to post a picture of your question in class real quick, show me exactly what you're talking about. We can look at it. But I put that KISS trading plan right above you too if you want to take a look. And we'll talk about it. But guys, when you show me where you entered, oh, no worries. Maybe we can work together to find a better one. Or like PFI just did. He's like, hey, Mark, I'm curious about these 50-50 trades, which is your first medium probability trade. Is my entry the same as a high probability trend trade? And the answer is absolutely, PFI. It is the exact same entry in regards to areas inside of favorable large triggers. And then show me where you got out. Did you make it to the point where the market is likely to continue? Did you jump out short? And tell me why you did it. Because very often when you're working on a management plan, fear is a huge driver for exits. So the plan that I just put in the room, and we'll talk about it more, gives you a very pragmatic approach as well. But if you give me this information each and every time you post in the room, you and I are going to have a one-on-one discussion to help you recognize the advantages, to help you pinpoint your entries, whether we could do it a little better, maybe it's late, it's early, or maybe it's perfect. And you need to hear, man, you killed it, Mike B. You killed it, Scott Lyle. Best entry ever. And then you get that little confidence, that little, okay, cool, I'm starting to get it. And then we'll start working on management together too with exits. And then the second half is use your spreadsheet. Guys, Nexgen gives you the spreadsheet. It's in the Nexgen Study Picks folder. It is your trade journal. It is your, initially, every time you take a trade, win, lose, or draw, take a picture, drop it in here. The same picture that you post in the room, drop it in your spreadsheet. And it's going to ask you how you felt, what were the advantages, how did it end up? And then it's going to give you a spot in the notes. This is where you put the feedback. So if you drop something in the room and I go, man, your entry is just a little bit early, let's look for this spot, it'll reduce your risk. Drop that into the notes, because what you're going to do is you're going to go back every morning and you're going to study these trades. You're going to take 5 minutes with a cup of coffee and you're going to look at what you did yesterday. And you're going to say to yourself, you're going to ask, what worked? Because what's working is what you want to repeat. These are the patterns that you want to start really registering into your brain. And then what didn't work, right? Those are those losers, those problems, those mistakes that we celebrate, because they're going to make us better as we move forward. What felt easy, typically having the advantages, feels pretty easy. And what feels forced is when you begin to recognize your rules and recognize that you're breaking them. And everybody does. Don't feel bad about breaking rules, guys. The newer you are, the more you'll break them. Trust me on that. But what happens is when you go back and study these each morning, it's going to prepare you for the day. You're going to focus on not breaking those rules. You're going to focus on embracing those advantages. And this little study each morning will accelerate the learning. And then your spreadsheet has a couple pages. The second page is called My Personal Trade Setup Looks. This is where you're going to begin to develop a plan. As you begin to recognize these patterns that fit the rules, you're going to put it into the personal trade setup looks. Whether it's a momentum trade or a high probability trend trade or a medium probability trend trade, when you find that look that makes you happy, that feels right, that's been proven to win more than it loses, guys, begin building your plan. And then as you do that, I've provided about 275 pictures of clients building their plans, client trades. Most of these revolve around the advantage of momentum, a clear path, and an entry area. There's the entry sequence for getting into the market. There's some management things. And the other tabs outside of the green, Josh, I know you're starting to go after that NASDAQ. Here's a little NASDAQ wisdom. Every great entry has a management opportunity. So there's a section to work on your management plan. Patterns that repeat themselves. You're going to see it over and over, guys. You're going to see these patterns repeat, whether it is three divergence stopping the trend or the gap theory or whatever. Start taking pictures of them. And then there's a whole section dedicated to those likely to stop areas, termination conditions, because this really is the most broken rule out there. So we've created one for you to go through. And your job is to take this picture and make your site look like it. Start filling these out on management, on chart reading, on terminations, and start really getting these patterns burnt into your brain, because what happens is once you know the looks from a standstill when there's nothing going on, it becomes easier to catch them when the market is moving. It's almost like the market slows down. So let's get going. We just burned up 15 minutes, guys. Let's focus on some advantages. Everything starts on the large chart. Everything starts on the large chart. And the large chart, the first thing that it's really going to do is it's going to keep you pointed the right direction. It's going to do that with the background color. If the background on your large chart is green, we're in an uptrend. We're only looking for rules to be met for high probability trend trades long, guys. This is the absolute safest way to approach the market, especially as a new user. If everything says up, go up. And if everything says down, the background is red, go down. Look for the rules to be met to go down, because by never fighting the trend, guys, you're going to eliminate tons of mistakes. And let me show you just how easy it is. This is the NASDAQ. The background is green. I know I should only be looking for rules to be met to go long. This is the S&P. The background is green. I should only be looking for rules to be met to go long. And then crude oil has the exact same thing going on, guys. So that's three different markets, each one with a green background. And I'm only looking for those three advantages to be met for a long trade. Rule number one says that we must have strong triggers. That's the one that creates the advantage of momentum. So to have strong triggers, first and foremost, your trigger lines must match the background. Trigger lines are two parts, guys. Small triggers, solid lines, and large triggers, dashed lines. And these two work together to create strong triggers. When the small triggers break above the large triggers, when they create space between the two, this gap between the small and the large, wide, angled in the direction of the trend, this lets me know that the odds are favorable for the market to continue in the direction of the trend. Odds favorable momentum is your first advantage, and it's provided by these strong triggers. In a downtrend, when the background is red, smalls are below the large are wide. The space between the two lets me know that the odds are favorable for the market to continue in the direction of the trend. Guys, this is an amazing advantage because strong trigger lines push the market in the direction of the trend. Strong trigger lines will break areas. Those key areas that can stop the market can also be broken with all that momentum. And strong trigger lines are the best of the best look for using that smaller, faster chart to buy support when everything is up and strong, or to sell resistance on that smaller, faster chart when everything is down and strong. On your large chart, that broad stroke, it just looks like this little tail or wick. Can everybody see that? This little wick is a pullback on a small chart. You're going to pinpoint exactly where this tail is likely to form. This becomes your entry for the highest probability trend trade. This also becomes a study tool because if you scroll back and you circle these tails on a large chart historically, you'll be able to see if the entry rules were met on the smaller, faster chart, and you can start really creating that catalog of pictures of high probability trend trades. So is everybody comfortable? That was a pretty quick review, but if the background is green, we're looking for longs. If it's red, we're looking for shorts. And it's that separation, guys, between the small and the large that lets me know that the odds are favorable for the market to continue. This is your first advantage of momentum. And then if you have the advantage of momentum with space between the two, well, then the advantage goes away when the smalls work their way back inside of the large, right? It's playing Pac-Man. It just ate your small triggers. This is what we call a weakening of the large triggers. And when we weaken large triggers, guys, anything can happen up or down. You'll see this precede a reversal very often. As you come into key areas, those triggers will weaken, but it lets you know that the momentum isn't present. So areas are less likely to break. The market is less likely to continue in the direction of the trend. Andy, you need to tighten up your shot group, mostly how to use NinjaTrader and capture properly. You had 3 get lucky trades yesterday. Would have done better had you not been fumbling around. No worries. So let's do a little NinjaTrader 101. We'll do a little capture 101. You have TechSmith capture, right? Cool. So what we'll do is let's go through the rules real quick, and then we will start our second hour with a full capture 101. And then hopefully we'll get all your answers on that. And I'm going to do the same thing with NinjaTrader. So we're going to talk about capturing a picture. We will talk about moving charts, scaling charts, and we'll make all that happen in the second hour. Sound good, Andy? Do not let me forget. I'm putting it on you. Do not let me forget because you guys have been with me. I'll see something shiny and it'll be all over. All right, so rule number 1, guys, the advantage of momentum happens on the large chart. Large chart leads the way. We've already defined direction. It's green. We're looking for up. Now we've defined momentum on that first bar. Check it out. Smalls above the large are wide. Everything says up. Now we need to define the areas, guys. Now we need to define where the market has the potential to stop. And the areas happen on a large chart once again. The large crowd react to these areas, guys. The people that move the market, buyers and sellers, the people with enough capital to make things happen, to create that momentum, they react to these areas. Buyers may exit a condition or a trade. Sellers may enter a trade. Profits are taken. Trades are entered. Decisions are made at these key areas on your large chart, guys. And those key areas can be divergence high and divergence low lines, places in the market where momentum was lost. You know that it was lost because the magenta line prints from a high pivot or the cyan line prints from a low pivot. It just means momentum's not following price. We're going to look for these yellow 1-to-1s, red Fibonacci resistance, and blue Fibonacci support, guys. These are the areas that the large crowd reacts to, where decisions are made. You guys can see them hours in advance, sometimes days. And it's a simple recipe to determine whether or not those areas have the potential to stop the market, whether or not those areas have the potential to break. And the recipe is really pretty basic. Everything begins with price reaching the area, meaning that these dynamic Renko bars, the ones that fluctuate up and down, that drive you nuts, guys, if they reach one of these decision-making points, decisions may be made. So that's the first step in determining whether or not an area is likely to hold or break. When price comes down and reaches Fibonacci support in this case, all you have to do is ask yourself, where are my triggers? If my triggers remain above support, small and large, stay above support, in the moment, that area has the potential to stop the market. You don't know if it'll stop the market. You don't know if it'll create a bounce. You don't know if there'll be this giant fight between buyers and sellers. But that simple look, price reaches, triggers remain above, tells you no more short trades. Let's wait and let's see what happens. And one of two things are going to happen, guys. Either the fib area is going to break or it's going to reverse. And it's really pretty simple. If it's going to break, both small and large triggers get to the other side of support, and support behaves as resistance. The area is broken when small and large get through the area, whether it is support or resistance. Support begins to act as resistance. Resistance begins to act as support. But now the path is clear. And that's the second advantage, guys, is making sure that you haven't reached an area. Making sure that you have room to your profit target. And you'll see this play out throughout the day. Price comes down and goes up, and it creates the cyan line, which is a divergence low, which means that there was a loss of momentum. But you'll notice that triggers got through support, and they didn't get all the way through. And this is just that indecision. These are decisions being made at a key area. But when price comes back to this divergence low, and you ask yourself, where are the triggers? And the answer is every trigger is above that key area. You know to not take any more short trades. This is called a pivot stop out of a prior divergence. And it just means that the loss of momentum, the buyers pushed up, but the sellers weren't done. And when the sellers came back to the point where the buyers stole their momentum, the buyers unloaded on them. They absolutely let loose, and that ends up reversing the market. So if a termination condition reverses the market, we call that a strong bottom. That is the best of the best. That is the look that sets you up for the highest probability trend trade that you can take. Price reaches resistance. Triggers remain below. You guys know, hey, no long trades, not yet. Even with the green background, even with the green triggers, we've reached an area that may stop the market. And thank goodness, right? Because look at the push. The sellers take over and push all the way down to Fibonacci support. And when they get to Fibonacci support, you start the process over. Where are my trigger lines? They all remain above support. No short trades, guys. 90% of your day is spent waiting for these advantages. From support, pushes all the way back up to that same Fibonacci resistance, to that divergence line that was created, as well as a second area of resistance. There's another one of those pivot stop outs, and these become even more powerful when they coincide with Fibonacci. This termination ultimately reverses, right? All the triggers are below resistance. We haven't reached support. The momentum is there, and there's one of those tails, guys. There's your highest probability trend trade. You guys are pinpointing where that tail is likely to happen, entering the market after a termination that reverses the market. And guys, this is the 70 to 80. This is the big winner. This is where your patience, the 90%, pays off. So are you guys good with the idea? And let's see on crude oil if we had that happen a little bit. We'll start here. Price reaches Fibonacci resistance and it pulls all the way to support. The triggers can't break. And you can actually see the consolidation in the market in between fibs. Pushes all the way up. Can't really finish the move to support. Almost to the tick where it bounces. To resistance, none of the triggers break. And that starts that push down all the way to the key fib area where none of the triggers break. Guys, your money is made in between key areas. Your money is made easily or more effortlessly in between the key areas that are creating bounces And now price came from here. Small's below the large are wide. They're angled in the direction of the trend. There's tons of momentum down. Whoa, what did I do? So we're looking to see what happens here. But both small and large are not through the areas yet. The areas aren't completely broken. And that's kind of what we're looking for. We're looking for that clear path as a brand new user, making sure that both small and large get to the other side, because that's where the advantages happen, guys. So is everybody okay with the very basic concept? Price reaches an area. If no triggers break, it's okay to sit on your hands and do nothing. It's okay to say, I'm not sure what the result's going to be here, therefore I will do nothing, and I'll wait and see. If the small and large break through, well then my area is broken, my path is clear, my momentum is there, and there's one of those tails, guys. You're going to be able to pinpoint where this area is. And then there's the third scenario. No triggers break. We're just going to sit on our hands and do nothing. Small and large break through. The area is broken. Resistance is now support. And guys, now we have where the smalls broke through, but the large haven't. Jim, I don't have to because I'm always teaching this class. There are people that choose not to trade right at the open because of potential volatility. And you never know if it's going to be there or not. It's kind of like news, right? If you know that the potential for volatility is right there at the open, it's okay to not trade. It's okay to say, you know what, this is the perfect time for me to toast a waffle or go refill my coffee, or a great time to go walk the dog around the block real quick and let them open, let them sort it out. But I'm always teaching, so it's not even an option for me in here. I would say watch it for a week and see what the volatility looks like. Is it consistently untradeable, or is it just a rare one-off? So everyone has a different opinion. We're going to talk about your medium probability look, guys. We're going to talk about your first trade that is not high probability. And that is when strong triggers, odds favorable momentum, the absolute best of the best, is pushing your small triggers, smashing your small triggers through the area that you're wondering if it's going to hold or break. When small triggers smash through an area, not just peek their little heads above it, but literally go blazing through with odds favorable momentum, guys, these fibs have the potential to break. Strong triggers break areas very often. 50% of your trigger lines get above resistance. 50% of your trigger lines, the large trigger lines, remain below. This is what we call a 50-50 look. The dotted magenta lines, are you talking about these right here on this picture, Mike? Those are small swing 1-to-1s. I don't know why they're in this. They show up on 8. I don't have any rules for small swing 1-to-1s. They are used by some traders. I think that's why they got put in there. So when the large swing 1-to-1s are yellow, those are 100% Fibonacci alternates. They're from big swings in the market. These are from the little micro swings within. For me personally, if they line up with the key area, I give them a little weight. If they're floating in the middle of nowhere, I don't worry about them too much. Definitely worth doing a little study. Yep, absolutely. And if you go to Mike, just if you want, guys, in case you didn't know this was there, in the glossary of common terms, there's links to both small and large swing. You can see the mathematics that go into it if that's your thing. You're very welcome. So guys, this is a 50-50 trade. This is a medium probability trade. This area has the potential to break, but it's not broken because the small and the large aren't to the other side, which means that I do not have the advantage of a clear path, which means that this can't be a high probability trend trade. Guys, if the high probability trend trade has the potential to win 70 to 80% of the time, you've got to be realistic in understanding that that small or that medium probability trade, your win percentage is going to be lower. So when you couple it with the high probability, it's okay to be in the 50s, 60s because you're taking away that advantage of a clear path. And we're going to talk about how to take this one. I'm going to give you a plan for it. And everything that you need to be successful with this trade will come to you from the high probability trend trade. So terminations at a high. Price reaches, no triggers, no trade. The recipe never changes, guys. Price has to reach the area first. If price doesn't reach the area, it's a target, not a termination. Same thing at the lows, guys. Price gets to that area. You just ask yourself, where are my triggers? If the triggers haven't broken, sit on your hands and do nothing. There's no reason to guess. There's no reason to hope. There's no reason to wish. You've got a very, very effortless way of doing it. Price reaches Fibonacci support. Divergence low. Absolutely none of the triggers break through. No reason to take a short here, guys. It may bounce, it may break, it may reverse. Hell, I don't know. But what I do know is that I've got a very clear image that I don't need to be trading into this area, even if I missed this one here, which is okay. And then when we talk about terminations, I'm going to share this picture because we talked about 90% of your day being reading indicators, 10% of your day being trading. This is the most awesome visual of that. Even with odds favorable momentum, the market screams right into these yellow 1-to-1s, the large swing 1-to-1s, Mike, and not a trigger breaks. So what do? You do absolutely nothing, right? You say, I don't know, hands in the air. I don't have to hope, I wish, or want. I don't start saying things like it should, because it shouldn't do anything, guys. It doesn't have to do anything. We're trading patterns. From this area of support, these yellow 1-to-1s, look at the fight that ensues between the buyers and sellers. Trigger lines don't match. They don't match with each other or the background. Triggers remain below resistance. They remain above support. Guys, you're caught in a range. You're caught in this giant fight between buyers and sellers. And there's not one reason for anybody in this room that's trading high probability trend trades to make a shot at it, to hope that that resistance breaks, or to wish that those 1-to-1s would let the market go through. What you do in this 90%, what you do when there's nothing to do, is going to allow you to capitalize. Notice that the market reverses off of that area. We have a strong bottom. And then eventually small and large get above resistance and it begins to behave as support. Well, that's a clear path all the way to Fibonacci resistance. And I had that momentum that I'm looking for. And guys, there's your tail. You guys are going to pinpoint where that tail is likely to happen, and that becomes your entry for the highest probability trend trade. And it's not uncommon for new users to try to predict, to hope, to wish, to want. And a lot of people in the beginning, when they just want to be in every move instead of the best moves, they're losing, hitting their stop limits, right? 3, 4, 5, 6, 7, 8, 9, 10 trades where they just guess and they hope, and it keeps stopping them out and they get frustrated, and they're done for the day by the time the best of the best sets up. So embrace the idea that it's cool to do nothing. It's okay to do nothing. There's no reason to take trades when those advantages aren't present, because your plan should revolve around statistical advantages. My father-in-law always said, wish in one hand and poop in the other, and tell me which one fills up first. And look at the reaction, guys. It still hasn't gotten through that area, and there was just no reason for you guys to take that trade into it because rule number 2 wasn't met. Look how this support is holding. Holy smokes. Price pulls back to support. None of the triggers break. No reason to go short even with odds favorable, because you don't have a clear path. Is everybody good with this? S&P, right into resistance. I'm not going long. Not a chance. I have absolutely no idea if that resistance is going to hold or break. So I sit on my hands and I do nothing, because nothing doesn't cost a thing to do. We all good? Give me a Y in the room if you're one of my new users. Let me know that you're okay with the idea that if price reaches an area on the large chart, none of the triggers break, it's okay to do nothing, because we're going to talk about a small chart one. Cool. Thanks, guys. We're going to take a quick look at times when everything says down, the path is clear, the triggers are red, the background's red, and then that silly market goes up, right? Or with odds favorable momentum, everything's screaming to the upside, there's nothing in the way, and then for whatever reason, the market goes down. Guys, I've got one more termination condition. This is the only small chart termination condition, the only entry chart termination condition. This one uses divergence, those losses of momentum, rather than lines. On a small chart, 3 divergences in the same price range may terminate the trend. 3 losses of momentum. You see it visually. When the market goes down and up, if momentum is lost, you'll see the cyan line. But this line doesn't print till like the 3rd bar, guys. So this isn't price reaching the divergence low. This is price creating a divergence low. If it happens 3 times in the same price range, it could terminate the trend. It could push that thing up. It becomes more powerful when your small triggers work their way inside of the large triggers. When you get those anything can happen triggers, it's just you're seeing visually that weakness. 3 divergences, it could stop it. 3 divergences and weak triggers. Holy smokes, it's just things keep working against that push down. And then if that 3rd pivot's higher than the previous or lower than the previous from a high, you get a head and shoulders pattern, guys, and it becomes even more pattern. You're going to see this on your entry chart, on your smaller, faster chart, on that refinement chart. And you're going to see it happening when the large chart isn't capable of showing change, because the large chart's a slow moving chart, right? What happens in this one bar, we may get all that dancing, those 3 divergences, and it just says, hey, no more shorts, no more longs, and you'll see those 3 from a low or 3 from a high at times like this on the large chart. And that's the first use of those 3 divergences on the small chart. The second one is if you are in the short, if you did pinpoint where that tail was most likely to form, you get into the highest probability trend trade short that you could ever be in. It's not guaranteed to run forever, right? 3 divergences in the same price range might give you just enough information to manage out of that trade. Or 3 divergences at a high, I'm in, it's perfect. Oops, 3 divergence, let me get out. Let me take some quick profits. And then I'll wait for those advantages to come back. So 3 divergences on the small chart is a termination condition. And if you have it, you don't have a clear path. So large charts told you which way to go, right? Everything is green. So we're going up. Momentum is there. Small's above the large. Rule number 1 has been met. I have the advantage of momentum, a market that's likely to continue in the direction of the trend. And rule number 2 is met. I haven't reached Fibonacci resistance yet. That's a target off in the distance. Price has not reached an area. I've got a clear path, guys. Rules 1 and 2 are met. The large crowd is doing their thing. They're pushing it up and they're excited about it. Haji, use the same idea for areas. Great question. That's the same price range, right? So we're going to use the same idea. If your large triggers and your small triggers break divergence, then that divergence is in the rear view mirror. The same way when small and large break these one-to-ones, the one-to-ones are broken. So use that as your same idea. If your trigger lines haven't broke either of these, any of these, you're in the same range. Let me see if I can find an example of that. And this market's kind of going crazy, right? That's 3 in the same range. That's actually 4, 5, 6. This is a 4-point, a 16-tick range. And then the flip side is these 3 are in a range, and then the small and large get below that one, and it kind of starts over. These 2 are broken, but these 3 are still in the same range. And that one's just floating in the middle doing its own thing, right? This one doesn't get to be a part of this group because it's so far away. Does that make sense? And just, this one's way up here. Small and large get to the other side of it. Rear view mirror. Don't even care about it. We're starting over right here. Cool. And this is where that repetition comes and pays dividends. The more times you see this, Haji, the easier you're going to say, yeah, that's in the range, that's not in the range, right? On day 1, you're like, oh, shit, what's the range? Well, don't overthink it. If they're all close to each other, they're in the same range, and they may terminate the trend. So large chart. leads the way, right? Large chart, you're welcome, Haji. Great question. Large chart said up. Large chart said clear path. Large chart said the momentum was the absolute best. So now we're going to let the small crowd, those people that fight price, those people that fight momentum, those people that fight the areas, we're going to let them get us to our best of the best area, guys. And they're going to create this little push. Everything says up. The small crowd wants it to go down. We love the small crowd because they're going to get us in rule number 3. And our entry rule says that we're going to use a limit order, meaning that you're literally going to wait for the market to come to you. You're going to be that good at this. You're going to use a limit order to buy or sell an area, pullback, that little push from the small crowd, and you're going to let that pullback be right to an area inside of favorable large triggers. So while we used the areas on the large chart to determine termination conditions, we're going to use the areas on the small chart for entry. And we want those areas, fibs, mid bands, yellow 1-to-1s, we want them to be inside of what we call favorable large triggers. So when you say rule number 3 in one breath, you say that you're going to use a limit order to buy or sell a pullback at an area inside of favorable large triggers. And favorable large triggers mean that the large triggers and the synthetic triggers on your small chart. And the synthetic triggers are nothing more than the large triggers from your large chart, but they're kind of transposed over here to the small chart because when they work together, when they're wide in the angle of the direction of the trend, when they're one on top of the other, your areas have to be inside them. So the tighter that they are on top of each other, the smaller your window becomes. And the smaller your window is, the least amount of risk that you're going to have on a trade. So favorable large triggers for the new user creates the most manageable, lowest risk trade. And that's what we want initially, right? Because anything that wins 70 to 80% of the time is going to lose 20 to 30. So we want to be able to minimize those losses as much as we can. So rule number 3 is going to get you into the market at the area where it's most likely to continue, in an area inside of favorable large triggers. So when everything says up, when everything says clear path, when everything says it's time to go, right? The momentum is its best. This is going to be the look on your smaller, faster chart. And all you're going to do is you're saying to yourself, man, it's time to take a trade. I have all these advantages. Let's find an area inside of favorable large triggers. You're probably going to have odds favorable momentum, smalls above the large. It helps, even on a small chart. You're going to take a look at your large, your synthetics. Are they coming up like a shark about to breach? They should be wide angled in the direction of the trend. And then you're just going to gauge what areas are going to fall within them. Fibs, mid bands, yellow 1-to-1s. And these are your areas to watch. But it's not time to get in yet. This is where it could bounce. Here's my triggers. But I want the small crowd to do their thing. I need those fighters to come in. And the pullback, that little retracement counter to the underlying trend, it begins with a reversal bar. And that reversal bar is going to be red against all that green. And this is when you're going to create your window of opportunity. This is where you're going to be able to pinpoint where the market is likely to continue. Lyle, those are a byproduct of the calculations to make divergence lines print. They have zero significance. And that bums people out when they hear that. My brother's famous, probably not as PC. Divergence is like pregnancy. You either are or you are not. Divergence either is or is not. There aren't different degrees of it. But those percentages create the illusion that there is. It's just a byproduct of the calculations so that you guys don't have to compare price and MACDs. It's a great question, though. I gave them so much weight because I was afraid to ask the question for longer than I ever should have. So, guys, reversal bar prints, large and synthetic are up and strong, favorable large triggers. The area's falling within, guys. Yellow 1-to-1s, we got some blue fibs and a mid band. My window of opportunity. So when I say higher or lower divergence, let me do this window real quick, Haji, and then I got you. Because I will squirrel all over the place. Reversal bar prints, your window of opportunity for a long trade extends from the highest point of support, in this case the midband, to the lowest point of support, those yellow 1-to-1s, inside of favorable large triggers. You guys are going to activate a limit order at the highest point of support right there in that 79.20, 79.21 range. And this is where the market is most likely to continue, guys. This is rule number 3 for entry happening. And then once you activate that limit order at the highest point of support closest to price, there's really not a lot for you to do. You're not in control of whether or not the small crowd is able to push back. But if they do push back to that area, that highest point inside of favorable large triggers, you're in a long trade. And remember, you're in a long trade because the large chart had those strong triggers, that odds favorable momentum. You're in a long trade because the large chart had nothing in the way. It had a clear path, no terms, right? I can't spell. And you're in a long trade because when the reversal bar printed, you mentally drew a box from the top of the triggers to the bottom of the triggers. And this is why them being one on top of the other is so key. And you said, that's not my window. My window extends from the highest point of support to the lowest point of support inside of favorable large triggers. That's where the market's most likely to bounce. But because of those strong triggers, I'm not willing to try and put an order at the bottom because it may not get there. Because of that clear path, there's nothing to really bounce off of to push it lower. And guys, this becomes your best of the best. This entry right here is what I want you working on for 20 days, getting into the market where it's most likely to continue. And then you're going to develop this trust the more times you see it, that it may go to the second level, but you're still inside your window and you're not going to panic. You're not going to let these tiny little fluctuations on a small chart freak you out or get you out. And if it hits the second level, you're still cool. Man, I'm still where the market's most likely to continue. I'm really good at this, but I'm not really one tick good very often. And then even if it goes all the way to the bottom and you find yourself $80, $90, $100 per contract negative in a trade, you're good because you know that it's still at the point where the market is most likely to continue. Having the ability to recognize that, to identify that, to enter at that also gives you the ability to know where the market shouldn't go. And when the market pushes beyond that window, 4 or 5 ticks beyond the window, what you're going to be able to do is have a protective stop. And that protective stop is going to pull you out of the position. It's going to create a loss, but it's going to create a small manageable loss because of that tiny window of opportunity, because of that point where the market was likely to continue. And this is where, as the brand new user, you have to remind yourself every day that anything that wins 70 to 80% of the time is mathematically obligated to lose 20 to 30% of the time. I'm never going to tell you that you're going to have 100% winners. And I think it's rare to find someone in the room that is 100% winners every day. I know yesterday I hit my goal, actually doubled my goal yesterday. I made it just over $1,000, I think. And I lost along the way about 500. So these smaller manageable losses make it easier to understand that it's okay. It's a normal part of a positive equity curve. But when you've got those advantages, when everything says go, when your triggers are the strongest, there's nothing in the way, and you pinpoint it, guys, this is the one that typically wins 70 to 80% of the time. This is the trade that you never want to miss. Because that 70, 80% of the time, it's going off to the profit target. It creates a very manageable trade through a beautiful entry. And you can see that it went beyond the mid band into the second level, and then it went a little deeper, right? Didn't quite hit the third, didn't make the one-to-ones. And then once it starts doing everything that it's supposed to do, you're going to reduce risk even more below that reversal bar, heading in the direction of the trade with all that momentum, with that clear path. And guys, that entry is what I want you to focus on for the first 20 days, because great entries create manageable trades. So when everything says down, when the momentum is the strongest, the path is clear, wait for the reversal bar. And when the reversal bar prints, you're going to identify from the top of your trigger lines to the bottom of your trigger lines. The tighter they are, the smaller the window. This is where you're going to look for areas. You're going to look for fibs, mid bands, yellow one-to-ones inside of favorable large triggers. Your window of opportunity for the short trade is from the lowest point closest to price to the furthest point, furthest away from price, lowest to highest. This is where the market's likely to continue. Your job is to activate a limit order at the bottom of the window. Come on, picture. There we go. You're going to activate a limit order 1 to 2 ticks below that lowest point of resistance because of the momentum, because of the clear path. And guys, if the market decides to pull back to you, you're in that short with all the advantages. And your stop is going to go where the market shouldn't, beyond that window of opportunity. This little sequence is on the spreadsheet. And I'll give you the spreadsheet right now. I'll drop mine in the room so that you have it. Are there any questions about finding the entry? Are there any questions about using the areas inside of favorable large triggers when the rules are met? Let's see if we can find an example. We're circling that tail. And guys, it's holiday, so there's not as many, but I want you to see this. And let me take the confusion off for you guys. Odds favorable, right? Everything says up and I circle that tail. Look how the circle lines up with support inside of favorable large triggers. Obviously, 3 divergences in the same price range. You may not take this trade, but the pattern still holds true. Like the pattern is still very real. Your first tail right here before things go sideways, and I think there was an area there, yeah. Right back to support inside of favorable large triggers, guys. And this happens all the time. All the markets. It happens in stocks. It happens in futures. It happens on the S&P. It happens on crude oil. Look at that once again. Any questions about this entry, guys? This is your focus for the first 30 days, first 20 days, whatever, first 2 weeks until you're comfortable with it. And then your job is, if you go back and circle these tails when the rules are met, and it does line up with support inside of favorable large triggers. Are you ready? Who needed the lesson on, is it Andy? We're about to do capture software. And I'm going to do, Haji, when I say lower divergence, higher, lower divergence. Keep it simple. Don't overthink it. Let me go back to tops and bottoms, and we'll just look at this one. This divergence is lower than that divergence, right? This divergence is higher than that divergence. This line is up compared to that one. This line is down compared to that one. So from a low, this divergence, which is higher, the third pivot, that creates a head and shoulders. On this one, this divergence is lower, right? Don't overthink it. It really is that. If this is higher than the previous, it adds power. If it's lower than the previous, it adds power. That's it. Yeah, simplicity is my thing, man. I'm not smart enough. I want to be. That's my brother's job. My brother's job is to be smart enough. My job is to teach you guys how to read indicators in the easiest way possible, because that's what I need. All right, here we go, guys. For those of you that need to post pictures, because I want all of you posting pictures, Capture software was downloaded on your computer when you got the indicators. If you go to your search bar, you should be able to Google TechSmith Capture. Guys, this is the most important part of your training. The people that post the most make the most. Trust me on this one. The people that put the most pictures in, whether it is a trade, a pre-trade, a post-trade, whether it is a question about what's going on. And then, Scott, I see your picture. I'm going to give you the quick reminder, brother. Tell me why you did what you did. Tell me why you're looking for. Tell me what you're looking for. Let's talk about it. Let's talk about what you see, why you did it, where you got in, where you got out. Give me the opportunity to give you the best feedback. If you don't write anything on your chart at all, I'm going to look at it. Oh, good Lord, that's small. Hold on. I'm going to look at it, and I'm going to say all of my trigger lines were below. Here you fought momentum and 3 divergences against you, right? Everything says down, but you went long, but you decided to hold on to it and you got out. Scott, you didn't have momentum. You did have direction. You were trading indeterminations, and you're fighting those large triggers, small triggers. What made you choose this entry, right? What made you say, yeah, despite all the red, I want to go long? And I don't do that to beat you up. There are no wrong answers. But what it does is it gives me the opportunity to talk about the chart reads, to compare what you see compared to what I see. Because what I see is three divergences, right? I see large triggers down. I see small triggers rolling down. I see everything below resistance. I see every indicator's down. Your large and your synthetics don't match, and there's no areas really. Well, you have a mid-band. What made you hold 5 points, right? What made you hold $225 per contract, $450 against all of this? And is that a great plan for longevity? And Scott and I had that plan so he could post in the room to talk about why it's so important to put those annotations, why it's so important to let me know what you're thinking, because you may stumble onto the next great trade, or you might have just gotten lucky. And I'm going to tell you, luck runs out. Look at that. 1, 2, 3, 4 divergences in the same price range. But you have it going the other way, right? Nothing agrees. And that's why I always do that, guys. Tell me what you're looking at. Sorry, Scott, I didn't mean to use you for an example there, but that was perfect timing. All right, so capture software, guys. How are we going to use it? We're going to click this giant button that says capture. Once you click it, there's a couple things that can happen. If I just let it hover over one chart, it's only going to give me one chart's worth of information. And that's just not enough, right? Because we're two chart traders. So I want you to go to the top left corner of your large chart and mash down your left mouse button. And don't let it up until you drag it all the way down to the bottom right. Some of the things that help me help you. Make sure that I can see the timestamps so that we can line up your entry chart and your large chart. Let me see the price bars so that we can do the same horizontally and vertically. Once I release it, Nexgen Capture is going to, or Nexgen Capture, Capture software is going to give me the opportunity to capture an image. And if I click it, for sure, Tater Bear, it brings me the picture, guys, and this is where the magic happens. This is where we get the opportunity to have a conversation. So if you went through the drill where you circle the tail, let's go through the idea of writing the rules on the chart. Write the rules being met. And you can use these different shapes up here. Like there's an arrow. Because you had odds favorable, draw an arrow, right? Because you hadn't reached an area, draw an arrow to the top of the bar on your large chart. And because you waited for support inside of favorable large triggers, draw an arrow to what it is that you're looking at. And then more importantly, take this call out button. And it's click and drag as well. Left click and drag it down, and it's going to create this box. And this is where you're going to type strong triggers or momentum or odds favorable momentum or giddy yap to the upside. Something to let me know that you know that there's an overwhelming amount of momentum with this look. Because what happens is if you draw that arrow to momentum to this look, then it opens the door for us to have a conversation about what it means to have the best of the best look. And that's really what I'm looking for. If you draw an arrow to something that doesn't represent what you're typing, then it opens the door for that conversation to make sure that you really understand what it is we're talking about. Price hasn't reached an area, right? So we know, again, with click and drag, make a box, no termination, clear path, right? Room to target, whatever you need to put on there to let you know that there's nothing in the way to create a bounce. And what this does is it lets you see your rules met, and it lets you take the words and associate them with the look. So we're creating recognition through repetition. And then I think the most important thing that you can write on a chart, because entries are where the magic happens. Entries are the best of the best, and they create manageable trades. I want you to write out, bought a pullback to an area inside of favorable large triggers. And I want you to use that language every time. Probably a scammer, Dwight. Guys, Nexgen will never ask you for money. They will never ask you for anything via text. We'll ask you for money over the phone, but we won't do it through Discord. We won't do it through Skype. So what you've done here, and Andy, this is the best way to do it. Identify your three rules, right? Identify your three advantages: momentum, clear path, and entry area. And then visually draw to them on the chart. And what you've done is you've created this. I mean, this is perfect, right? This is everything that we're looking for, everything that we teach. So the first thing I'm going to do is I'm going to click copy. When I click copy, it goes onto my clipboard. I'm going to come over to the room. If it's in the pop-out, I have to hit Control-V. If it's not in the pop-out, I can right-click and just hit paste. And I'm going to drop that picture into the room. And what that's going to do for me is it's going to open the door for us to have a conversation. I respond to pictures in order of printing. If you ever need to leave early, let me know. I'll look at it. But from here, Andy, what I'll do is I'll open that up. And I'll say, all right, Andy, let's see what you did, brother. You've got odds favorable. Man, that's perfect. You couldn't have done that any better. And you're absolutely right. An area wasn't reached. Rules are met on the large chart. This is your read. This is what you need to make sure you recognize, and it sets you up for that pullback to support inside of favorable large triggers. Andy, I don't think you could have done this any better. I think you've really nailed all the rules that we're looking for. You know what I would do if I were you is I would click upload, and it'll take that media and it'll drop it into the screencast cloud, and it'll give you a link. If you click copy, it's going to put it on your clipboard. You could also drop that link into the room. But Andy, that's your best look. That's the one you're going to build a plan around, right? So let's go to favorite looks. And I'm going to take that link or that link that I just copied to my clipboard and see how it goes into the link there. And it's app, screencast, numbers, letters. I don't want that. That doesn't tell me anything. So I'm going to make sure that I highlight it, and I'm going to go to insert. And I'm going to click on this link button here, and what that does is that opens the door for me to make a hyperlink. Paste my link in there, and then up here on text to display, write it in there, Andy's Perfect Long. And now what you're doing is you're building a plan. You're creating this recognition through repetition. So go and find 50 of these. Go find 50 longs. Go find 50 shorts. Go find the best of the best, right? And begin building your plan. So that's how you're going to use Capture software. And then if you just hit close, it's going to get you set up for the next trade or for the next picture. And then because I like to give fish and I like to teach fish and all that, I'm going to go to the software user guide and I'm going to give you the link to everything that I just said. No worries, CJ, I got you right now. And CJ, that's the perfect way to do it. CJ posted in the room and he's like, dude, I got to go. And I'm like, well, let's look at it. Let's talk about those advantages. And you made it easy on me because you talked about it. So, CJ, I know this is your trade, right? Those links will help. Andy's just repetition. Once you do it a few times, you're good. At 75, where's 75? 74.92. So up here, Andy, how was the or CJ? I'm sorry, odds favorable, right? Best of the best look. That bar hadn't reached support. Best of the best look. CJ, don't be afraid to write that on the large chart. Remind yourself why you're looking for an entry, right? Remind yourself why you're taking this momentum style trade. And then with all that momentum, strong triggers, you're adopting kind of the look that Ron C does. Have a clear path, have momentum, take your entry. GTFO, right? There's a big blue fib there. Awesome. Andy, I'm not done with you yet, though. We're going to do a quick little Ninja Trader. So, CJ, beautiful. I've actually got, 3 or 4 trades from you that look exactly the same. You are developing your plan. So, CJ, your job, like I did here. Look, that's the one you presented the other day. I put it in the best looks. Same darn trade. Outstanding. It has nothing to do with a high probability trend trade. It has everything to do with momentum and a clear path. You just found your entry. I love it. I love everything about it. And just as you develop that repetition, as you develop that mindset of what it's going to take, go ahead and annotate your large chart with what you see, because it's just reinforcing why you look for the entry. It will pay dividends, I promise. Great job, CJ. Was there another one, or was that the only one? Awesome. So from 92 to 82, there's $100. So quick 230, right? Do it on a 10 lot. You'll never work. You will never have to leave it in 20 minutes again. Nice job, dude. All right, some NinjaTrader basics too. And this is on 7, Andy, but it translates. Guys, your most current bar on NinjaTrader is represented with a black highlight. And if you ever see where there is no black highlight, there's going to be entry videos. Let's go through some of it, though. Because 7 and 8 are the same, Lyle, so we'll go through quite a few things here. First, we're going to go through scaling. The most current bar is always highlighted black. If you don't see that black highlight, look in the upper right-hand corner for an arrow. And if you click the arrow, it'll bring you to the most current bar. See how it went to black highlight? That's huge. But look at this. I hit the arrow, and I don't have any price bars. Well, that means that price is somewhere off the screen. It doesn't mean that my software is broken, and you'll see that capital F. If you click the capital F, well, then it centers. There's your most current bar. You can see it wiggling on the same price right there. Some people have a little OCD, and they want this to be centered. If you need to drop it down, hold your control button and click on the horizontal, and you can shift the whole thing down and make it centered. New users, if they're in long trades, they put it down here so that there's room to run. But if you want to get it back to where it resets itself, that F will always get you back. On the horizontal bar, if I just hold it and drag back, it's going to stretch me out. If I push forward, it's going to tighten me up. Make it readable. Everybody's chart's going to be different. If I hold control and click on that bottom, it's going to move the whole chart left or right. And if I have this huge gray and I'm like, I need it back, click the arrow again. Same thing over here, vertical. If I just click it, I can tighten it. Guys, you can't trade a market that looks like that. And you probably can't trade a market that looks like that. So find your happy medium. Click the F, put it where you need to be. And if it trades off screen, F resets you, arrows get you back. And those are great. Just practice with those a little bit. And then when you use the entries, so Nexgen gave you guys different, what do you call them? Open up. Different ATM strategies, which is just auto trade management. So in yours, you're going to have, Lyle, all of these different ones. 2 lots, 12 tick stops, 16, 20 targets. You're going to pick the one that fits best for you. And that's just right in the ATM strategy box. You always want to make sure that there's an ATM strategy. And what that does for you, let me give the link to that too, I guess, would make sense. So to find your ATM strategy, guys, right below, just click and pick one. So in this one, this is the S&P. I'll go S&P 2 lot. And I can minimize it. But since this is my entry chart, let me go S&P 2 lot here. And what this means is that I'm going to be trading 2 contracts. And I've got a predetermined stop and target. So if I enter the market, let me give it a little bit of room. I'll go with momentum. I don't know if this is a trade. It's going to put me into the market. It's going to show me 2 contracts. It's going to show me my stop, and it's going to show me my targets. So far, so good. If price comes down and hits my stop, we'll make it easy. It'll pull me out of the market. I have a loss. If price hits my target, it'll pull that first contract out of the market for a profit. My second contract stays in place. And then I can move it. Let's say maybe there's a fib way up here, right? And I'm like, everything is strong. I need to make that target further. I'm going to click on the line and I'm going to move it up. But the original one stays in place until I click again. Same thing with my stop. If I get a reversal bar and I need to tighten up, I can click and drag and I can move my stops and targets like that. If I just want to exit, hit close, get out, right? That's the easiest way to do it. It's just hit close and get out. Sometimes I'm going to forget to put a strategy in. Left click. Everything's left click. Right click will always bring up this. Left click is going to grab hold of it. Left click is going to be able to move it. Left click is always the primary. But do you see how I got into the market and I forgot to put in stops and targets, right? And I forgot which direction I went. So hold on just a second. So let's say I buy the market, but I forget stops. I forget targets. Oh man, how am I going to protect myself? So if I buy, the opposite of buy is sell. So the first thing I'm going to do is I'm going to put a protective stop in place. I'm going to right click below it and I'm going to put sell stop to. Now I have a stop in place. Now I can put that where the market shouldn't go, and that's going to help me. But I'm in two contracts, which means that the opposite of buy is sell. So I'm going to put sell limit to, and there's my target. And if it hits a stop or a target, I'm going to move it so it gets my stop. When you put it in manually, you have to cancel out the other side. And that's really it. I'm a big fan, guys. Go through and practice with this a little bit. It'll help a lot. Just getting in on simulator. Don't worry about it. Don't worry about whether you win, whether you lose. Just focus on being able to get in. Focus on being able to put your stops in place, your targets in place. Go through and make this second nature so that when you do go live, if something happens, you know what you're doing quickly, guys. That's what simulator's for. It's not just practicing the trades. It's practicing the management of it. And then there's also, here's your moving and scaling NinjaTrader charts. There's a video for you right there. If you want to increase or decrease. So the user guide is all your NinjaTrader how-to for you guys. Is it only day? Oh, you're finally on there. You finally got your computer. Rock on. And then keep asking those great questions. That's the key, guys. One of the biggest things is ask those great questions. Tater Bear, show me a picture, man. Show me why it was a great entry. I'd love to see that. And then, guys, I want to backtrack a little bit to the high probability trend trade. I want to give you guys a couple tools to use. And the first one is the high probability trend trade checklist, guys. The first one is just your reminder. Print it out, put it on your desktop. This is what it's going to take to get me into the market. These are the rules. This is where they're at. This is what they mean, right? And just print this out and put it right on your desktop. And every time you're looking to take a trade, or if you're circling those tails, doing it historically, compare. Make sure that you're doing it. And what do you mean by good practice? To get used to losing? Lose them all. It won't sting as much. So, Andy, what's cool is they're already in your NinjaTrader 8. Typically for crude oil or the S&P, especially if you're brand new, 12 is a great place to start. But remember, It's just do ticks. Because remember, Andy, show me the picture, Lyle. Take a picture of it. Because we're going to do the exact same thing, right? S&P. Let's take a look. Hold on. Let me tighten it up. Let me show you guys how the pictures are great, right? Everything starts on the large chart. Large chart says down, right, Lyle? That's okay. We just did a pretty big run through on using it. I'll do it again later if you need me to, for sure. And then here's one too that you can go after. So let's go through the rules. I don't have odds favorable momentum because I don't have smalls below the large and the large aren't wide. I don't have a clear path because the market reached Fibonacci support and a divergence low and absolutely no triggers broke. So there's no rules for a short trade and there's no rules for a long trade right here. Where were you long? I haven't had a clear path for longs all day. I really haven't had a clear path for shorts all day. I can say with the utmost confidence that there were no rules met either direction. So I'm glad that you were able to use these key areas and maybe steal a little bit right in the middle, right? But I don't know how you did it. So I need those pictures and then we'll talk about how you did it because it might have been brilliant. You might have said, well, when this held and these rolled, I hopped in and hopped out and I knew that this was a bad spot, 28.75, and that's what took me out of it, right? So you took profits at the trouble spot, which is brilliant because it only went a tick above it. And that resistance ultimately held. So we can go through the whole process and look at the advantages and the disadvantages and see if we can create something repeatable. Does that make sense, Lyle? Without sounding preachy? I hope. But guys, I'm going to finish up the first hour and then we're going to go back and we're going to start looking at pictures. And I know everybody's excited about me seeing their pictures. So let's do this. Here's your trade list. What's it going to take to get you in the market? Embrace it, guys. Advantages are there. Here's the exact same list with pictures of what it means. Termination creates a full reversal. Odds favorable, weak triggers. Not broken. We saw this on the S&P all morning. There's your clear path. There's your potential to break. Identifying your window of opportunity. So I'm going to give this one to you as well. And guys, if you embrace the idea that you just focus on these three advantages for a little bit, it's going to make all this easy. And you'll never have to ask me, hey, Mark, was there a signal? There are no signals. There's only rules met or rules not met. And then, guys, I'm going to give you a plan because you have to have a plan. You have to know what you're looking for. And this is a stepping stone in your learning journey, guys. It's designed to optimize your chances with the high probability trend trade and with a 50-50 trade, that area with the potential to break. It's going to be your simulation, study, class feedback, and continuous practice. You'll be empowered to craft a plan tailored to your personal goals. The way CJ is taking those momentum trades, he's doing that because of his input. The way Ron takes those momentum trades, the way, I don't know, there's quite a few people in here that take things outside of the high probability trend trading. Guys, they're all outstanding trades, and they are based on their experience reading the indicators. That's what we're growing towards right now, is we're learning to read indicators so that you can create a plan. But this is a simple plan for consistency. Guys, this plan is designed to keep you on the right side more often than not, to keep you focused on the best of the best as you learn to read your indicators. And it starts with don't fight the large chart direction or triggers. If you can do that, you'll eliminate 60 to 70% of the trades new users make. Just don't fight the large chart direction. Don't fight the triggers. You'll find a point in life where you can pull it off a little bit. But in the beginning, keep it easy. Go with the flow. Define your entry. Learn how to get in at the right spot, guys, because great entries create manageable trades. Great entries reduce risk. Great entries maximize profit potential. And then you've got to learn to manage it. So we've created a management plan that's just as methodical as the entry, just as mechanical as the entry. And it all begins with a great entry at an area inside of favorable large triggers. If the rules are met and you take a short, this is your entry. And your stop goes where the market shouldn't, right? And remember that this entry is predicated, it's 100% based on the large chart. The large chart said down. The large chart said clear path. The large chart said take the entry because the rules are met. You just defined your entry. If it continues up to that stop, guys, you take a loser. It's normal. It's cool. 20 to 30% of the time it has to happen. But more often than not, the market's going to give you a reversal bar in the direction of the trade with the momentum, with the direction, with the clear path, with all that great stuff. You're going to reduce your risk a tick or two above it. This stop placement allows you to minimize losses on trades that don't work. So Andy, when you talk about the cash number is non-existent. The cash number, we start with 12 ticks on an S&P trade. We start with 12 ticks on a crude trade, and then it's your job to place it where the market shouldn't go. And it'll be your job to move it above the market when it gives you the reversal bar. And this is very methodical, guys. It's very pragmatic in the beginning because that's the easiest. It helps eliminate those emotions. Your first target is only $100 in this KISS plan. And it's only $100 because with all that momentum and a clear path, it's pretty easy to hit $100. I mean, you literally have a freight train pushing. And the likelihood of it not smacking $100 is pretty slim. And then you're going to move your stop to break even. Not only are you going to collect $100, it's going in your account, they can't take it from you, but you're also going to break even. So now you've got no fear of loss, right? It can't go against you. Or if it does go against you, you're not going to lose. And that's going to build the confidence for you to hold for the second target and remind yourself that the large chart said down, the large chart said clear path. And if it hits the second target, guys, that's a $300 trade. And that's what the KISS plan is designed for. The KISS plan is designed to give you the absolute best scenario, the absolute best entry, and the most pragmatic, emotionless plan for management that you will craft a new one when you learn how to read your indicators. But this keeps you on the right side of things. This keeps you focused on quick profits and getting paid rather than trying to be the hero each and every trade. And then below it is a plan for that 50-50 that might break. Guys, this KISS trading plan, many of you are going to outgrow it in the first week. Some of you are going to stick to it for the rest of your life because you love winning 70 to 80% of the time. It's up to you. Doesn't matter to me what trades you take, but we'll talk about each and every one of them. So that was your KISS plan. It's in the room. The high probability trend trade checklist is in the room. That one was dropped in there for you as well. The high probability trend trade checklist with the visuals have all been dropped in the room, guys. This is your plan for 30 days. Take 1 million pictures, drop every one of them into the room. Let's practice the right rules. Let's make sure that it's repeatable. It doesn't hurt my feelings if you don't take high probability trend trades. I don't think the trade is wrong if you don't take high probability trend trades. But when we start talking about these pictures, when I come back from my break, every picture is going to revolve around advantages. Every picture, whether it's a high probability trend trade or not, is going to revolve around whether or not you had momentum, a clear path, and an entry area. Because when you understand these three basic concepts, it opens all the doors for you. If you're unsure about any of them, I can't see your face. You have to raise your hand and say, Mark, let's talk about it. So when I come back, Tater Bear, you asked about divergence, right? Can I expand on the divergences and how to read them on the program? Absolutely. That's going to be the first order of business when I come back, and then we're going to talk about the pictures that you guys posted. So guys, go stretch your legs real quick. I'm going to do the same, and when I come back, quick divergence lesson. And Tater Bear, it's going to be simple, brother. I'm not going to overcomplicate it. I'm going to do it in regards to what it means on the chart and not much more. We'll get you there. Andy, there's ways to take it. Learn to read your indicators, right? Learn the trend trade. When you are great with your entries on the trend trade, or even more so, when you're great with identifying momentum, a clear path in an entry area, when you can pick out a termination condition, Your second trade, Andy, and it's funny as this plan has been in place for 20 years. Your second plan is this trade right here, the high volume area trade. This could be the second trade in your plan. Rule number one is a good top or bottom. You have to understand termination conditions, right? You have to understand whether or not there's room to the target. Those rules, those lessons come from the high probability trend trade. You've got to let trigger lines roll. You've got to be able to pinpoint your area. The same lessons from the high probability trend trade. So, Andy, there's tons of opportunities out there. Become a chart reader, and it'll open every door that you want open. I've watched it happen with a million people. And look at that. Caught between support and resistance, guys. There's just nothing to do, no matter how much you wish there was. Crude oil. Support, resistance, support, resistance, support, resistance. You guys know that it's 2 days after Christmas, right? And most people aren't even returning to work until next week after the New Year's. You're witnessing that and these indecision. There's not enough people to break out. So it's a great time for as many lessons as we can get. Guys, I'll be back in 5 minutes. When I come back, we will take a look at divergences. We'll take a look at charts. We'll read the live market. Start posting pictures. Start posting questions. I will see you guys in 5. back at it. Jim, it is just bells and whistles. Whoo, you got a lot going on. Are you looking at 4 different charts on your computer? Those are all the same picture. Oh, those are sequential. Jim, the easiest way with Snagit is take your pictures, and there's a show recent at the bottom, and just post them one at a time in the room instead of 4 at once. Makes it easier for sure, just visually. All right. But Snagit's the exact same. So you're going to click capture, same concept. Click and drag, same concept. Release. And the difference is Snagit has just more things that you can put on there if you want. Different text boxes, different shapes, different fonts, different stickers, and all that good stuff. And then from down here, you can actually copy, right click and hit copy and paste into the room. And let's say that you had this picture and you wanted to put the two together, you can actually drag it up in there and you can say, hey, check it out. There is the highlight section. I can't if it's just one picture. So what your link was for me was only one picture. So I can blow it up. I can do that and scroll through like this and drag it and go through. Or you could post just one picture, which should be easier. Either way, because which is the first? So that's 41, 112G, 9G, GC. Yeah, try that. But that way I can kind of go through. And I'm not sure if it's... Those are different trades, right? From the upper left down to the right. No worries, Tater, we're going. So when you take a picture, drag from the left to the right and then release and get those two charts on there. And then from there, you can literally right click and hit copy, or just right off of this, right click and hit copy and drop it right in the room. Guys, this is awesome use of the classroom time, by the way. And then just keep practicing these things, right? And then Andy, just practice. Click and drag, dude. Knock 2 or 3. The market's not doing it. You're not missing anything, right? This is a great day to practice with your NinjaTrader. This is a great day to practice with your capture software. So Tater Bear, divergence. Every time a cyan line prints from a pivot, or a magenta line prints from a high pivot, all it means, don't overthink it, all it means is loss of momentum. It means that price went down, then up, and there was a loss of momentum. It meant price went down, then up, then down. Price went up, price went down. That's your pivot. And then momentum didn't follow. There's your momentum. It didn't follow. Percentage means nothing. Nothing at all. Percentage is a byproduct of creating the line. That's all it is. It has no bearing. 16 is not a more powerful divergence than 9, which is not less powerful than 44. You know, these numbers are just byproducts. They have absolutely nothing to do with the strength. Divergence either is or is not. You either have a loss of momentum or you do not. So when we get the loss of momentum, when momentum doesn't follow price, the market has to go up and create the pivot, and that that loss of momentum doesn't print until about the third bar, halfway through the third bar. That's where you know it. You know it all the way here. That's when you know that there was a loss of momentum. It is, mine goes dash, dash, dash. It looks like a dash line to me. So it'll be a dash line. Momentum from a high, or divergence from a high, divergence from a low. It just means that there was a loss of momentum. Are you cool with that? The way we're going to use it on the large chart, Tater Bear, it just makes me smile to say Tater Bear. This is how we're going to use it on a large chart, all right? This lets me know that there was a loss of momentum right here at 74.79. It doesn't mean that there's a reversal that's imminent. It doesn't mean that I should go long. It doesn't mean anything other than there was a loss of momentum. You totally cool with that? This divergence becomes significant on the large chart when price finally comes back and reaches it a second time. Now we have what's a line in the sand. At this point right here, and let me write it out the way that it helps my brain. Divergence at a low means the buyers stole the seller's momentum. Does that make sense? That's all it is. The buyers stole the seller's momentum. They said, yeah, to hell with you guys. You're not going any lower. We're going to take away your momentum. And then when I have it over here and price reaches it, let's do this. Let me drop my font size just a little bit. That visual representation of momentum loss is a line in the sand in the event that the sellers try to push below it. The buyers are typically waiting right there. So, yep, so what we have is the visual representation, and this is how to use it, how to read it on the chart. If it comes off the end of a pivot, it's divergence. If price reaches it and the triggers don't break, it's a termination. And that's all it is. It's just a loss of momentum, and then we'll use it on a large chart to identify a termination condition. The only one that may create confusion is the one-to-ones, the small swing one-to-ones. Let me see if I have one of y'all's charts on here. Is you may see the dots. I should talk to my brother about this. That's kind of a pain. Those are small swing one-to-ones. And I'm going to talk to him this afternoon. And notice how they don't come from a pivot. Notice how they're just kind of floating in the area the same way the yellow ones do. Divergence will come off of a pivot. Divergence will have that negative number, even though that it's not really important. But you'll see the negative number off the pivot and then the line. That's the easiest way to differentiate between the two. And the small swing one-to-ones are going to be very pronounced dots. No, they're just from small swings. So when you go through and you go to the glossary of common terms, your one-to-ones are from big swings. There's a lot of action that happens within the measurement. And this is getting more technical than I typically like because all of it's irrelevant in regards to utilizing the software. Understanding how this is made has nothing to do. But look at all the action that happens within, right? The small swing one-to-ones It's just the exact same recipe using tinier movements. This is the stuff, forgive me, that it doesn't matter. Like, you don't have to be able to build a watch to tell time. But visually, I can see how it's important to be able to recognize the difference between the small swing one-to-ones and the divergence. And that's the easiest way to do it. Is divergence will have the numbers. Yeah, for sure. And those are the only two I think that should be confusing or have the potential to be confusing. You'll see divergences from lows from highs, the numbers, the lines. So on the large chart, they can behave as termination conditions. On the large chart, they can literally, if price reaches and the triggers don't break, that's your indication to hold on. Don't try to break it yet. And then on the small charts, when those three divergences print, three divergences on a small chart may terminate the trend. When you see that same thing, three negative numbers, three lines, it can terminate the trend. And that's how we'll use it on the small chart. You can use it to either not take the next short trade or to manage out of a trade that you may be in. Does that help a little bit, Tater Bear? Good for now. Right on. Well, if you come up with more questions, let me know. I'll keep going. And there's a reason that I try to keep it super basic. There's a reason that I try to keep it focused more on reading the indicators than understanding the creation of the indicators. And I try to keep it real focused on what it means to you guys in regards to taking a trade. So, but I'm not opposed to talking deeper into it. I just want to make sure that I don't confuse you from the basics. Because the basics are so important. The basics, that foundation, is what opens up all the doors for you. All right, Gary got us going today with the first picture. We're going to get into that picture look. Third divergence, not at resistance. You don't have any fibs there, Gary. Everything says up and you went short. You're above all the areas of support. You went short and held. Sometimes, guys, if you're going to write on your chart, make sure that you write what's actually happening. Makes it easier. Gary, you're showing me stuff from a different plan. All right, Jose, 50-50 trade. So here's that first look at a 50-50, right? Small triggers broke through the area. Large triggers did not. This area has the potential to break, guys, but it's not broken yet. This is your first medium probability trade. Not coming from an area. So Jose waits for market flow confirmation. At the bottom of the window, and it went to the top of the window. And I think this is great stop placement, Jose. You get in at the bottom of the window because of the momentum. You keep your stop where the market shouldn't go. And then when divergence prints on an area that isn't broken, you start to forfeit a little bit of momentum. And you're just saying, I'm not going to give up momentum and a clear path, and you're out. Great management, Jose. Understanding that it's not high probability gives you the opportunity to manage it a bit more aggressively. Nicely done. All right, and then Scott. And this is the S&P. And kind of established that there wasn't a whole lot going on in the S&P. And this is kind of a tough one, right? So if we look at your entry, the small triggers are up, but the large triggers are down. We're below resistance, which is not a clear path. And we're trading against two divergences. That one hadn't printed yet. And then the flip side of that is I have a beautiful termination condition. I have these one-to-ones that have stopped the market, that none of the trigger lines have broken through. And Scott, I think that was probably where your brain was, right? Your brain's going, dude, look at this. None of the triggers are broken. The smalls are getting back above the large. What an opportunity for an awesome looking bottom. What an opportunity for this market to continue back up. And I see it, and I agree with it 100%. It's just a little early because of that giant Fibonacci resistance with all the triggers below it. And I understand why you took your entry, because you're thinking this good bottom, smalls above, everything turns green. Let me go with the mid band right there at the large triggers. And this was just a little early. If it's really going to hold, if this is really going to be the bottom that stops everything and makes it go, things are going to roll a little bit over here. You're going to get that better look, and everything will line up and agree. So I think it was a good read. You had a termination. It was just a little, you didn't get enough information there yet to be able to give you enough advantages to really make you feel warm and fuzzy. But great read on the terminations. Just need to get that resistance out of the way. And then Cav, and there it is, termination, everything reverses, best of the best momentum. That fib update came in on you, Cav. And this happens, guys. Every 2 hours, your fibs are going to update, and look at that. And Cav says, whoa, that's a big blue fib with no triggers. Look at his entry. Directly at support, inside favorable large triggers. Look at his exit. Right at that area where all the triggers are below. And Cav, I'm not sure that there's a better way to do that. You had the advantage of momentum. It wasn't quite a clear path, but because of the perfect entry and all charts agreed, it made it pretty effortless to get up there. You're happy but never satisfied. You and John Novak, Andy. You and John Novak. But for those of you that are new, that are with me, do you see how everything agrees for the trade? And I'm telling you that this is when good things happen, guys. It'll get to the point to where it'll feel obvious. You're like, oh my gosh, everything says up. I have strength on both my large and my small charts. I have areas inside of favorable large triggers to create a bounce. This is when it starts to get effortless. This is when it really becomes easier and easier. All right, Tater Bear. Don't know the terms yet, but this was the red. We got to pull back to the far dotted line. This would have been the entry at the area of resistance right there at your large triggers. Target 1 at those pink 1-to-1s. Target 2 at a blue fib. All right, Tater Bear. So let me help you with terms. The first thing that we always need, right, is strong triggers. Gives us the advantage of momentum. Whoops. Tater Bear absolutely nailed it. Small away from the large, larger wide. They're angled in the direction of the trend. Everything about this says that this is a market that's likely to continue down. Rule number 2 says no termination conditions. You had not reached the area yet. You got close, but you didn't reach it. No termination means that you have a clear path. That's rule number 2. So Tater Bear, awesome. You have momentum. You hadn't reached the fib. You have a clear path. And then you just wait for the pullback to the area right there at the inside of the large triggers, and it becomes a pretty effortless trade for you. Tater Bear, this is beautiful. That's an amazing look. That's a termination that creates a full reversal. The full reversal gives you odds favorable momentum. The odds favorable momentum gives you a clear path, sequential. With that clear path, you take a pullback to the area inside of favorable large triggers. It does, especially on NASDAQ. Happens really fast. That's why the average user, Tater Bear, learn your patterns on crude and the S&P. Learn your patterns on something that moves a little slower. It'll make it easier to catch them in the moment on the large one. You did great. And then let's talk about the other thing. Are you ready? So this is your first post, but it's certainly not your first trade. I won't make you trade in the room, guys. I'll never make you trade in the room. The reality is it just that's not for me. But it looks like you lost it. Possibly there. Looks like you went short straight into support. And things didn't work out. Tater Bear, this trade's easy. Feels good, right? Everybody look at me. I'm a badass. I'm not saying that you're saying this, but that's what your brain tells you. Show this one. Everyone will be so freaking impressed. This one is where the lessons are. This one is where you learn how to not give away your money. That's the one. The ones that you don't want to show are the ones that need to be showed, guys. Tater Bear, you can do this all day. That's the perfect pattern. That's absolutely picture perfect. Nothing wrong with it. What the hell could possibly go wrong? There's no lessons in this other than reinforcement of the pattern. Over here, we're going to see what it looks like when things aren't perfect. Over here, we're going to see what it looks like when there's a challenge, when the pattern isn't perfect, so you know how to avoid it. So your brain automatically says, no, Tater Bear, no, don't take this trade. Because when you take this trade 2 or 3 times a day, everything's great. Something to think about. Losers are where the lessons are, guys. Took a 50-50 trade, pull back into large, 5-1. Your stop just below divergence, synthetic triggers. All right. So termination, reversal, and you took it right here, 50-50, right? And then gap theory. Beautiful stop placement. And let me show you guys what I'm talking about that aren't Cav, because I know Cav knows about it. When you hit something, in this case a mid-band, and there's room to make a full bar before it gets back to the large triggers, guys, this is what we call the gap theory. Cav, I like your shot, right? It's more likely to go from down here, right at the large triggers. Guys, this gap theory keeps you patient, right? And it keeps you from having to put a huge amount of risk on a trade because when price reaches an area and the large triggers remain a full bar away, it's very likely to close that gap. And that's exactly what Cav knew, which is why his stop was in the right spot, which is why he was able to get paid on that one. He was able to embrace patterns that he'd seen repeatedly to know that his stop belongs down here. And with all that momentum coming from a termination, he knew right where the trade was likely to go. Beautiful trade, Cav. Great stop placement, great management. When you understand where the market is likely to continue, it becomes easier to have intelligent stops. All right, and then Jim, let's go through yours. And let me line these up just to be sure. So there's one common theme. Jim, are you with me in here? There's one common theme on each and every one of these charts. And I hope that you're in here. Rule number 2 is not met. Rule number 2 is not met. Rule 2 is not met. Rule 2 isn't met. So on each and every one of these charts, you traded directly into a termination condition. You did not have a clear path on any of them. On this chart, your smalls are above the large, which means that you don't have odds favorable momentum. But on this chart, it's beautiful odds favorable momentum. Are you with me, Jim? Are you still in here? So one of the great things about getting feedback, and it looks like Jim's already split. One of the great things about getting feedback is you're going to figure out what your thing is. Termination, 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 termination. This one right off the termination results in a loser. Rule number 2 could have kept you safe. And then have no idea what happened on this one. But the other side of it is you'll notice that he used the checklist. And he put that there were no terminations on every one. And he put that there was odds favorable momentum on a chart where there wasn't. And what you'll find, guys, is when you post in the room and you write what you write on here, it gives us the opportunity, gives me the opportunity to give you feedback on what you're seeing and what may have actually been happening. Here it says room determination on the 13-2. Yes, absolutely. Not so much. Triggers didn't break. Does that make sense? I hope that makes sense for you guys. Truth in advertising, right? Making sure that what you're writing on the chart matches what's actually happening. That's why we post in the room. You're learning to read your indicators. Remember, guys, I know how to read indicators. I'm pretty good at it. So good that my brother has me teaching this class. You need to make sure that you guys can get it. Andy, I like that you posted a picture. 4821. Your charts don't line up. I know you're practicing right now. I know you're practicing and getting better at lining up those charts. Click that F at the top on your large chart and make sure that you can see the highlighted number so that you can see what's happening on both. Great first picture, man. David, everything says down. Everything is strong. Window of opportunity. Easy money. All the way down. Solid, David. That's the same one that Tater Bear showed us. Absolutely beautiful. And then C-Dub. Doing market replay, making money. On the last trade, you got in with 2 contracts. First one took profits early, really helps with confidence. Second, didn't realize the market made it to previous divergence line, held too long, but it was still +2. Also saw if you get out, you can get back in with a new opportunity. Absolutely. And you got in momentum style, C-Dub. Right? Little pullback, go up. Not really a trend trade, just a momentum trade. And then you knew where you could have gotten out, which is solid. I love it on market replay. I love it on market replay. Just remember, you want it repeatable. Everything on this was predicated off a great momentum. Everything on this was predicated with a clear path. So write that on there, right? Making money is important, but if you're making it through luck, it's hard to make it every day. C-Dub, I like it. It's a great momentum style trade and great management opportunity. And that understanding that it's okay to get paid and then get back in. Especially most markets offer so many opportunities. Is your logic correct in this picture? David, can I make life easy on you? Because I like you so much. Let me make it easy on you. That mark means nothing. That chart with no other information means precisely jack squat. And this is the hardest part about learning to use market flow, David. No, I like it, but you don't need that. I didn't even look. What market was it? That was the NASDAQ. So let's go to the NASDAQ and see what's happening in real life right there. Because your small chart doesn't tell you anything. Here's your NASDAQ. From support to resistance to support, down straight into the mid-band to support to resistance. This tells you that it's chop, right? Doesn't your large chart tell you that there's not longs or shorts? You don't need a third chart for that, brother. Because 2 things are going to happen. And this happens a lot with people when they incorporate the market flow chart. Is the same way your large chart tells you don't take a trade, David, you will find an opportunity to somehow find trades in here and saying, well, the market flow said go long, right? Or the market flow said go short, or the market flow said go long, or the market flow said go short, even though your large chart said, dude, don't do it. Don't do it. You don't have rules met. Does that make sense, David? It gives you heartburn. Tater Bear, it's freaking amazing if you remind yourself every morning that market flow signals carry weight when the rules are true, when the rules are met. Whether it's a high volume area trade, whether it's a trend trade, market flow can be an awesome confirmation tool, but it has to be a confirmation tool. It can't be a precursor to taking a trade, if that makes sense. I love my market flow chart. I use it every day. I use it for management. I use it for a lot of different things. But I always make sure that the rules are met on my large chart, my small chart first. But yeah, David, you will see that in a choppy market. Awesome. And then Cav using the idea of a termination condition, right? Price reaches support, absolutely no triggers. Everything says down, and Cav says, man, I sure as hell hope that holds. And it did. And it did, right? He's fighting momentum, or at least small momentum. He's fighting everything red. He's fighting all the triggers. But I want you to see the cool thing as Cav says, check it out, guys. That's 3 divergences in the same price range. That's a pivot stop out. Every trigger on every chart is above support. If I had to pick a look where support's most likely to hold, this is it. Let me see if I can't capitalize. And then once again, guys, this is awesome trading. This is awesome trading based on chart reading, not based on those 3 advantages. So nice job, Cav. Talk about heartburn. That one gives me heartburn. But it's great for Cav. It makes sense to Cav, right? But isn't it just the basic lessons? No triggers break through. I can't go short. Well, if I can't go short, let's see if I can go long. 3 divergences in the same location says it may terminate. No triggers through says it may terminate. Why not give it a go? I like it. And then Rod loves that. The pivot stop out, the divergence, at least to get back up to the reversal bar marker. I see the chili dog. And David, did you miss where I talked about yours? That's a sexy trade. You want to talk about that one divergence? All right, David. So what are your rules? Are they, and just help me out, momentum, clear path, and an entry area? I'm doing this for the lesson, David, but that's what you're looking for, right? Large chart, strong triggers, terminations false, take the area. No deviations from that I should know about. So let's do it. Large chart leads the way. So large chart says direction. Everything is down, right? So there's the first one. Large chart says momentum. It doesn't get any better than that, does it? Large chart defines areas, haven't reached the area. So what does that mean? When the large chart rules are true, let me go to a smaller refinement chart. To here it comes. It's about to be big font. Find my entry. Guys, the most important phrase that you can put on your small chart is that it's your entry chart. Right? So David, all you're looking for is your entry here, right? And where does your entry come from? It comes from the window of opportunity, that perfect area right inside of favorable large triggers. You feel pretty comfortable with that? Rules met, rules met, rules met. That's awesome. So this divergence causes hesitation, which is cool. And there's actually an outstanding lesson in this, David. Because when you let one divergence on the small chart change your whole perception of a plane, of an area, When you let the small chart define your areas, no triggers below that area. What's your area? A small swing 1-to-1? Because doesn't the large chart define areas? Isn't this chart showing me where my trouble is at that big blue fib? Show me in your rules, David, where your small chart defines termination conditions. Show me in your rules where your small chart defines a termination condition. They're not in the rules. Okay. Well, then on a small chart, what would make me second guess? Having odds favorable momentum and a clear path. What's the only thing that might make me second guess that? 3 divergences, absolutely. And David, we're talking through this. I know that you know these lessons, but in the heat of battle, it's easy to focus on something that you're scared of, right? It's easy. It's target fixation. If you've ever ridden motorcycles, they tell you to look where you want to go, not where you're going, right? So it was the perfect trade, David. It was the best of the best. Everything on your large chart, it could have never been any better than that. Is it better to see the divergence on the large chart or small chart? I know, David. I know that you knew it, but for me, in my trading, remember, John Novak is my coach. John Novak is who I show pictures to. I'll send him a picture, and my brother will go, "Hey, let's just back up and talk through it again real quick. Let's talk about the advantages that were present. Let's talk about what we see." And this was big for me. And if you remind yourself, large chart leads the way, large chart leads the way. That's the only thing. Tater, so what does divergence on a large chart do? It gives you a potential termination, right? So in regards to a termination condition, it's better to see divergence on a large chart. What do 3 divergences on a small chart do? They create a termination. So, it's not a reversal. It has the potential. There is no... Whoops. 1, 2, 3, 4, 5, 6, 7. 3 divergences doesn't guarantee a reversal. It doesn't, nothing like that. But what it does is it says, hey, the market may push up, right? 3 divergences, the market may push down. You're range bound right now. You can see it with the divergences. And this isn't when I'm worried about these. Come on. Sorry, I'm making messes here. Times like this, when the large chart is clear, I don't give a shit about 3 divergences on a small chart. My large chart's defining areas. Let me show you where I do care. Let me see what it looked like at 9:30 a.m. At 9:30 a.m., I got 3 divergences in the same price range. And that corresponded with a clear path and triggers up. Does that make sense, guys? So I use the small chart divergences to help me see change when the large chart isn't at a key area, when the large chart has a clear path, when the large chart maybe looks like it's going to continue in the direction of the trade. I can use 3 divergences just to see the change happen a little bit faster. 1 divergence, more often than not, and David, we see it in your picture, 1 divergence is exactly what I need. Let me find your picture. Thank goodness for that 1 divergence, because that little loss of momentum on a small chart pushed me right back to the perfect entry, didn't it? Thank you, divergence. And you'll start getting to that point. Thank goodness that divergence was with those small swings. It just pushed me back to my entry because the large chart said go. Thank goodness for that fib on a smaller chart because it pushed me right back to my entry, right? So you'll learn to kind of appreciate these things on the small chart. This line gives me a shot at getting to my entry, right? This divergence helped push it there. But until I see three of them, until I see three divergences, man, my large chart's going to tell me what I'm doing. That's David, that was awesome. That was one of the best lessons ever because everybody goes through it. Everybody goes through it. I'll use this termination or this divergence if price reaches it and the triggers don't break as a termination. In the moment, it means nothing to me floating down here. It's squat, diddly squat even. Until price reaches it, it's just a pretty little line on my chart. And since I don't have rules for a trade, I'm not looking for, I don't have odds favorable, I don't have a clear path. These three divergences, yeah, they're there, but I've already got no rules met over here, so I don't even need it. I'm just waiting. I'm in a holding pattern. I'm in a waiting pattern. Great stuff. Guys, I love slow days in the market because it lets you guys start talking about what you want to talk about. It lets you guys start talking about the things that you've been thinking about but you didn't want to interrupt class with, right? I want you guys to interrupt class. All right, let's see what we have. E. Webster, are you with me in here? You sure are. All trigs down. Strong triggers. Plenty of room to the fib. With this divergence, should have held for further area. Entered the mid-band inside of triggers. So let's look at it. Odds favorable momentum, righty? Without a doubt. Strong triggers. Coming from a good top, I love that. Haven't reached the fib, beautiful. We can agree, even with these giant, massive triggers, I don't know what those are, we can agree that the rules are met without question on the large chart, right? 21-3 triggers. Have you ever seen Last Samurai? So how did these 21 triggers play into it? Just reinforce, which is cool. I like it. But rules are met on the large chart, E. You got no worries. We got strong triggers, clear path, everything says go. You only have one divergence in strong triggers, right? This is the lesson that we just had. That one divergence hopefully gets you back. And then you get a reversal bar from beyond if you decided to hold it. And your stop's appropriate. But the large chart still says down. And E. Webster, this is one of those things where the jerks that are pushing crude push it higher, right to resistance, right? And it just kind of happens. You had a 100% rules. It's just one of the 30%, man. That's all it is. I love everything about it. And to be honest with you, based on your entry and the advantages, I could teach my first hour class using this picture as reference. It's that good. You have momentum. You have a clear path. You took the perfect entry. And there's two ways to think about it. You could say if 15 is where the market should continue, my triggers are there. It would have been appropriate to exit at 20, 5 ticks beyond it, right? And then say, if it goes beyond, I'll wait for things to agree again. You chose the reversal bar. And I like it. It's resistance. Every trigger below it, I mean, that's a beautiful stop. The fact that it came up, that's just somebody with a little more money. Little Christmas money pushing it up. Beautiful trade, E. Webster. I think your management's appropriate. I think your advantages were solid. I don't know that there's a different way to look at that one. It's just, it didn't work. And then CJ. Was this CJ or C-Dub? C-Dub. Market replay. I did get in at a trouble spot. Based solely on divergence on the 13.2, made about 12 ticks and put a second top +2, stopped out. But your faith was in the 13.2 divergence. C-Dub, it's just a loss of momentum, man. That's all it is. And it looks like you're missing fibs, but let's talk about it. This divergence says that there's a loss of momentum. And this is going to be a pattern lesson for you guys. See, Deb, are you with me in here? When this loss of momentum, as my voice cracks, happens from the middle of space, middle of nowhere, there's nothing to support it, no fibs, nothing. When this loss of momentum happens, this becomes my target. But you don't know about this one until the third bar, C-Dub. So this loss of momentum, you're anticipating a mid-band. And you got it. You got the mid-band. And off the mid-band, it pushes all the way back. And this is one of those spots, man, where you're either gonna get the push up. Your large triggers are still down on the large chart. The mid-band has already held on the large chart. There's no divergence on the small chart. And you're really putting just a lot of faith in kind of the middle of nowhere moving averages. I like that you waited for it to start to go up, to bounce off of the triggers and start that push up. And at least that gives you a little bit of an advantage. And one of the things you can do too is when all your triggers kind of come together and you get a divergence off of the low here, just a little confirmation, looking for that entry. Divergence to the mid-band is a pattern that happens a lot. Without a fib there, waiting is hard, man. It really is. But if you start going through, and I know that you're working on creating rules for yourself right now, identify everything, right? Put that it's not coming from an area. Put that you're fighting the large triggers. Like, talk about everything that's going on. And it's not doing that because it's right or wrong. It's not doing it because of whatever. But C-Dub, this may end up being your perfect trade. This may be the one that you never miss. This could be the one that you buy an island with, right? So as you go through the process of becoming familiar, make sure that you can define it well enough to make it repeatable. Does that make sense? So you might say, when divergence prints on the large chart, and the smalls get above the large, I'm going to look for an opportunity over here on the small chart that coincides with the retest to the triggers or something like that. And what it is you start building this plan that you can repeat every day, that you can go back. And no matter whether it's in the morning or the night, or whether it's crude oil, or whether it's the S&P or NASDAQ, you're like, oh, it's just a pattern. I know this pattern. I've seen this pattern. And this pattern is one that repeats itself enough. And when it does, I win more than I lose. That's part of my plan. So that's the only reason I'm going after it, guys. It's never right or wrong. All right. Large triggers not through the blue fibs. Forward divergence, pivot off red on the 13.2. Enter inside the favorable large triggers on the 5.1. Manage closely with exit plan because price is dancing at fib on the 13.2 and cyan line. So what you're telling me here, Dwight, let's start with the large chart. Just watch Fibonacci trigger lines. It gets easier, doesn't it? You're getting dumb? Numb. Oh, no worries, Tater Bear. Go enjoy your afternoon, man. 3 divergences is great. Resistance holds. Absolutely. Keep those great questions coming. Resistance held 1, 2, 3, 4, 5 times, right? I love that. That's a pretty good sign. And then you couple all this resistance holding. Everything is below this area of resistance. So we're not expecting a push above. And you are coming into that fib, but you're coming in with odds favorable. And no divergence on the little pullback. And you said, dude, with strength everywhere, down everywhere, coming from terminations, it's probably not a home run in a market that's been dancing. But I can definitely get in and make a little cash. And Dwight, great read. Is it a high probability trend trade? Of course not. There's not a clear path. Is it momentum? Without a doubt. Is it an entry area? Absolutely. And did you recognize there was a problem so you managed assertively? Without a doubt. Dwight, that's everything that we hope for. That's my goal for each and every one of you every time, that you can read your indicators and make a decision on whether or not you're willing to risk your money. The same way when everything's said down, you took the 50-50 and it didn't work out, and you're like, yeah, you know what? You had no idea that the market was about to get range bound. I like this one, even though you didn't share it. And check it out. Who was C-Dub? Do you see a pattern here, brother? Did you guys catch this? Divergence not from an area. Look at the first place it bounced. Uh-oh. What do you think about that tail? Pretty cool, right? C-Dub. Look at you developing pattern recognition. I would take that picture. I'd drop it into my spreadsheet. And this is one of those ones where, check it out. What is this? NASDAQ. Divergence not from an area. It's a two-part process, Haji. When I'm talking about whether or not an area is likely to hold or break, right? Let's go through it real quick. The first thing, let me just go back. The first thing that I look at is price reaching the area, Haji, because the reason for that is on your large chart. I want you to think of these potential termination conditions. These are where decisions are being made, right? So if everything says up, even with momentum, when price reaches these yellow 1-to-1s, decisions are going to be made. They're going to be made either by the sellers that decide to get into the market or fight the buyers, or maybe buyers are going to take profits. Maybe buyers 79.40 is where they were going, and then once they get there, they're like, I don't care what happens. I'm going to take all my profits, right? So price reaching an area becomes a catalyst for decision making. Does that make sense? Hey, Lyle, good job, dude. 362 a day. That's a $72,000 year. That's not a bad year. So price, we use it in the equation, Haji, to determine whether or not the area is likely to hold or break, right? But then once we do that, once that decision making starts, we're going to use the triggers, because the triggers are a moving average. And we want that moving average to be above the decision making point. So here, the small triggers peek their head through. The large triggers couldn't follow along, even though price went through it. What is that? 5 points, 6 points? So we let the trigger lines tell us, for the high probability trend trade, until the large get above this area, it only has the potential to break. It hasn't broken. And then if you go back to 23, you'll notice that as it peeks its head above here, see those losses of momentum? That's your giant red flag that says, dude, it's probably not going to happen. And it has nothing to do with price. The small trigger said that it might with the momentum. And then your small chart says, no, we're losing momentum here. Let's not try to get in at this mid-band. And then that third lower is what lets you go. Not necessarily. It depends on the trade you're looking for. So let's look at the two scenarios, right? Great questions, guys. This is the easy one. If there's no triggers, it's pretty easy to just say, all right, let me sit on my hands and do nothing. And you're good with that one, right? This one is without question. Just stop. Let's see what happens. This potential for an area to break, Haji, this is huge. But the idea is that you do it correctly. That you have odds favorable momentum, right? Large triggers aren't necessarily more important. They work as a team. And they work as a team because when they both get above, then it's broken. But this look right here, these small triggers breaking through, smashing through, That's what creates that 50-50 look, that medium probability trade. And medium probability trades are going to end up being most of your trades. So what you do is when it has the potential, see how the large are lagging but the smalls have smashed? This is where the small chart comes into play, and this is why being able to read your indicators is so important. On the small chart, and I even put it on here, my money is worth a perfect entry on the small chart when I have the potential to break, which means that I have strong triggers, smalls outside of the large, right? Because I don't have a clear path, I don't want to sacrifice momentum. I don't want to sacrifice momentum with weak triggers on a small chart. I don't want to sacrifice momentum with divergence on a small chart. So this, for me, this look becomes 100% mandatory when it only has the potential to break. I also want to have the smallest window of opportunity. I want to have the smallest point for a bounce so that I can have the least amount of risk. Because, Haji, if it's not broken yet, why on earth do I want to risk $300-400 on an area that only has the potential to break? So it's not that the small or large one's more important. They'll define when the area is broken. But this is an outstanding look to take advantage, to make money, when the small chart gives you that look that it's okay. And then you see it again here. It has the potential to break, and no divergence and strong triggers in a little window says, yes, I'm willing to take a shot, even though the large triggers haven't broken. I'm willing to take a shot because this is perfect, even though this isn't. Does that make sense? And that's the key to the 50-50, Haji. The areas with the potential to break is outstanding, and there's a ton of opportunity there. But making sure that your small chart supports it. I think that was an outstanding question. And then if you go back to the KISS plan that I present, you're welcome. Here's that 50-50. Notice that it says one area not broken. The KISS plan is developed or designed to give you the best chance of success. One area not broken, because the more areas that have the potential to break, the more you're hoping that momentum pushes through not just one area but multiple areas. So odds favorable momentum on the large chart and the small chart, that's key. That's a huge part of it. And then notice that it says no divergence coming from a good top or bottom. So here's your recipe to take those 50-50 trades the best. And the small and the large are nothing more than, right? None of them break through. The smalls broke through this area, but they didn't break through this area. There's no reason to go short here. And it's too soon for longs because I don't have any momentum to the upside. And now the smalls are through, but the large are not, which means that the area has the potential to break, but it's not broken, right? And since it's not broken, and I don't really have advantages, I can sit on my hands and do nothing. And then crude oil, here's a great example. Resistance never let up, right? And support never let up. But once the small and the large get below that area that had been holding all morning, look at the breakout that happens. And it's a straight shot. It is a straight shot to Fibonacci support. So what you witness here is a fight between buyers and sellers, and ultimately the sellers won. And now we're right at that key area. Is that where they were trying to get? Or is that where the buyers have the cannons loaded to go to the upside? And we just don't know. We're going to find out over the next couple of minutes. And guys, I want to remind you that right now we're holiday trading. We are caught in between Christmas and New Year's. And there are so many people, just like yourselves, that don't have to go to work. And the people that go to work to trade the markets, well, they may not be there, but the patterns still work, right? Fibonacci support with no triggers through still held the market. And look at the fight. And if you took a crude trade in there, you broke your rules if you're a high probability trade trader. And there's some days where you just got to realize the advantages aren't there. The trades aren't there. The patterns aren't setting up. And it's okay to do nothing. And I think that that's one of the biggest challenges is everybody wants to be rich today. Everybody wants to be top of the heap today rather than being consistent every day. And consistency every day is the key, guys. Doing that same little bit every day. If I can make $100 5 times a day, that's it. Just a little $100 trade 5 times a day. Guys, that's a $2,500 week. That's not a bad week, and that's a $10,000 month. And guys, that's 6 figures off of just 5 little $100 trades. I don't have to hit home runs. I don't have to fight areas likely to stop the market. All I need is momentum and just take a little chunk. And I was going to say, Ron broke his rule because of the strength of the triggers. I'm glad I looked over because I almost called you on that. But with that much momentum breaking out of consolidation and the clear path, Ron just jumps in and takes a chunk. That is 6 contracts. That's $660, guys. Was that your first one of the day? $660. One trade. He's done. Go undeck the halls. Yeah. I'm not allowed to do that till after January. My wife loves the halls decked. All right, guys. I'm going to take a quick second. I'll leave you guys with crude oil. Let's see if they wanted to break or not. And then think of a question. You know what? She is, knock on wood, Ron. She's amazing. And then we're jerks. We freaked her out. We rescued her. She was in the house for less than a week, and then we took her on a road trip to a new house. Poor girl. And introduced her to my son's dog. She had a blast. Oh, and introduced her to deer as well. Not a fan. It was kind of funny. Guys, I'm going to take a quick second. When I come back, post a question. If I missed a question, guys, and I do miss questions every now and then. And David B., you had none that met your rules this AM. I'm telling you guys, that was my day yesterday. I kept my charts up, and I just walked into my office every now and then. I would say my charts were up for 7 hours at least. I took 4 trades yesterday, I think. 5 trades maybe. It happens some days. It's holiday trading, guys. Today is a great day to go finish off that jug of eggnog and the little bit of whiskey left and just take a nap on the couch. I'll be back in about 5, and then we'll finish with any questions that you guys have, anything that we can talk about. Let me know what you want to talk about. See you guys in just a second. All right, guys, let's finish strong. C-Dub. Before you got in, based on the rules, but got to divergence line, so possible pivot, stop out. Perfect. So, all right, C-Dub. Termination, reversal, odds favorable, but directly into a term, right? Directly into a termination condition. Did it stop you out? Without that divergence line, I love it. Beautiful. Oh, there are two pictures there? Sorry, I don't know. I can't always tell that there's two pictures. All right. So it pushed up, you held, got paid. There's your argument for the good top, guys. And from that bad bottom. So see, Deb, remember we talked about divergence from the middle of nowhere? Midband's the first target. That's why. Because when it doesn't hit a key area, the expectation is it has the potential to drop back down to finish the move. The sellers know where that line is. This is why that decision-making concept is so important. The sellers know exactly where 73.21 is. It's a key spot for them the same way it is for you. And when they don't get there, when the buyers push them up, that midband, that resistance, that's where they're going to regroup. That's just a moving average, comes back down. So when you come into the termination condition, but you're getting that momentum from a bad bottom, it's just a continuation. You're just looking to go, and you protect yourself behind the one-to-ones. Brilliant. I love it. One of those times, when am I going to trade into a divergence line? When all the charts agree. When the previous pivot's from a bad bottom, when it's coming off of resistance, and the large triggers didn't follow. Do you see how the gap theory there? Off the area, pulls all the way back. Right there is where those decisions are being made. Everything rolling and continuing down told you exactly what their decision was. Nice one, C-Dub. I like it. I like that you're using market replay too. I had a guy that was in, I used to teach a 101 class in the afternoons, and he would come in with about 20 pictures from market replay every day, and he'd annotate them, and he'd talk about what he sees, and he'd talk about the rules, and I'll tell you, he's doing well right now. But he was that person that he didn't just give me 2 or 3 pictures during the day. If there was a live trade set up, he brought me his study. He goes, hey, I was doing this. I was doing market replay and I was working on this. Here's what I think. Let's talk about it. And we did. We talked about it every day. And he's an outstanding chart reader now. And that's it. Once you're a chart reader, you're good, right? Weak triggers and a clear path. Weak triggers and divergence. It's likely to push up higher, right? Does everyone get that? And now price reaches resistance and every trigger line is beneath. Not going long into that look. NASDAQ's having a breakout. All that consolidation. Somebody had to win, right? So we're 50-50. We'll just see what happens. Guys, what do you want to talk about? Not a ton going on in the markets right now. Is there a concept you'd like to discuss? If there's a picture you'd like to share. You guys that are kind of new. Mike B., Miss Cindy, Adriana, Dwight, Sydney, Gary, Joel, Jim, Cab, Andy, James, Jose, Donna. Don't be scared. Should we call it and just let you guys go trade? We could do that too. Look at that momentum pushing. Just sitting on the hands for the ES. Sometimes that's your best bet, right? Do you ever play what if? If then, right? If I can get above this 26 level that they haven't been able to get above all day, and I get odds favorable, I'm going to look for the long, right? And if I get below 48.20, that level they haven't been able to break all day, then I'm going to look for the short. In the middle, it's just a prediction at that point, guys. It's just hoping. Hope is such a hard way to make a living, isn't it? E. Webster, there's two ways to do it. You can build a workspace with both markets on it. So you could literally build a workspace that has your crude oil charts and your S&P charts on it. You'd have to have the monitor space, of course. So you could run them both at the same time, one workspace, if that makes sense. So like if you opened up your crude oil workspace, you would go File, New Chart, and build your S&P on that same workspace. Or what I do, and it works for me, and I'll tell you why. If you hit Shift F3, it will toggle in between whatever workspaces you have open. And I prefer this, personally, just me. Hey, look at that. All the triggers below and down it goes. Because if I'm watching NASDAQ, right, and there's nothing happening in NASDAQ, and then I go to the S&P, and I think there's nothing going on in the S&P, and then I come to crude oil, and I'm like, oh, I just missed my short. It's a lot for me to think about. And if I'm trying to determine on 3 different charts at the exact same time whether or not my rules are met, it's easy when there's nothing going on. It's difficult if 2 charts are beginning to set up. It gets confusing. I have trouble managing 2 trades on 2 different charts, but I don't have the bandwidth most of you guys have. I can't watch that many things at once. I love 2 charts. I like to keep it simple. I like to look at 1 chart at a time and make decisions. So like right now, I'd say, oh, look at this. NASDAQ is up. It's strong. Everything looks good. I'm looking for something from here maybe. And then like that's it, right? That's all I need to worry about. I'm not going to go, all right, let me put that there. And then let me go here. And oops, man, I should have one here too because that might be a trade. And oh, geez, I better get one here because that might be a trade. And now I'm going, did it hit? Is it good? Oh my gosh, what am I going to do? How do I manage it? What am I going to do? And I've done that, which is why I know not to do that. So I like to just look at one. I like to focus on one. That's just me, though. I know guys that watch like 4 or 5 markets at the same time, and they never miss a beat. I'm not that talented. I wish I was, but I'm not. And then Cav's like, just give me 1 trade on 10 accounts. It's so much easier. So we all have our own personal pain tolerances. Yeah, so NinjaTrader 8, it's just, it's just like 7. So this is, and let me show you. So this is a NASDAQ one, right? Let's say I wanted to watch them all at the same time. All I had to do is go File, New, and build a chart. And let's say I want to watch the S&P with it. And I'll build my 13.2 S&P. And I'll put my template in there. And once I click OK, well, it's going to show up on the other screen. But I'm about to have an S&P chart right in the middle of my NASDAQ workspace. So depending on the size of your monitors, I like great big charts in front of me. Ooh, you know what? I put it on 90 days, so let me close that out instead of 10. But then what you could do is you could take it and you could say, all right, let me run my NASDAQ up top. And let me run my S&P right here. Let me run my, my crude oil up top and my S&P down low. So you could build it into one workspace. Just play with it. And then if you come into challenges, just let us know. We'll walk you through it. But I've got two 32-inch monitors, and this is my setup on one, and then I run my range chart on a second monitor off to the side, and then I play video poker when my rules aren't met next to it. So give me that little distraction. Everybody have a good Christmas. You get what you wanted? Get more than you wanted? Hopefully. I don't know. I got a box of Pro V1 X's. I told my wife I would never buy them as bad as I am, so she bought them for me. That's a good wife. And my kid bought me 500 tees, so I guess I'm going to go golfing. Anybody? I'll tell you what, it sounds like we're done for the day. Here's a little NASDAQ nuance for you guys. You went, why on God's green earth would you go short? Odds favorable, clear path, area of support inside of favorable large triggers. I am 100% rules met for a high probability trend trade long, and I'm even coming from a good bottom. So guys, when people shout, went short, went long, don't listen to them. They went short per their plan. All righty, Webster, riskier here with running into the term area. But isn't that just using the idea? Everything's set down, and when it pulls back and retests resistance, absolutely nothing blinked. And I love this because you didn't hold in hope, right? See, now there's no divergence. There's no divergence, right? That bar hasn't even formed. You have one divergence. Hopefully that pushes you back to an entry. Oh, look, and it's bouncing off the midband inside of favorable large triggers. I'll be darned. Take care, David. Do you see how that works, C-Dub, though? Sometimes you get so married to something that you forget about everything going the other direction. And then E. Webster trading directly into support, but you didn't take it until you got back to that resistance that was likely to hold, and you managed out of the trouble. I love it. And then you let it break and pull right back the exact same look to get back down. And E. Webster, this is what we have been teaching for 25 years. And this is on a bigger scale. Let the area break. Use it as resistance. Let the area break. Use it as resistance. Outstanding, man. Nice job. That's okay. Usually people have to take their own time, right? Because you'll try everything until you find something that really suits you. And then once you do, you just commit to it. And then there we go. See that? There's your divergence that pushes back to the midband, right? Well, I appreciate you being back and posting. So C-Dub, this pattern, bad top, straight to the midband, says maybe that short's not the best idea, right? Yeah, I like that one. That second lower divergence, that's the one. Let it be 2. Let it push. Give something that says it tried to go up, it couldn't. Second lower, man. That's huge for you, brother. Getting back to the midband, that's a solid one. And now that it's target reached, maybe not. And I was going to say, there's that little nuance for the NASDAQ. For you guys that trade the NASDAQ, if your small triggers are less than a full bar away, man, they act as resistance a lot. So waiting for a little confirmation goes a long way. Good stuff. Yeah, it's a good pattern, C-Dub. But you still, even with the patterns, it's dangerous to fight that much strength. It's dangerous to fight that direction and all that good stuff. On the NASDAQ, you're trading a 13.2 on the NASDAQ? Yee. And a 5.1. That's fast. Right on. But that's still, that one didn't print till here, which just didn't give you a whole bunch of room. You have spidey senses if you're trading a 13.2 and a 5.1 for the NASDAQ. Most people are trading a 34 and a 13. Slows it down a little bit. Because when the NASDAQ's really moving, 5.1 is damn near untradeable. I don't care how good you are at reading indicators. That's just me, though. No, I mean, do you. If you're comfortable with it, rock it out, man. Have some fun. If you download the indicators off the resource page, it'll give you a workspace for the other one. But it's totally up to you. When the market's not moving, if it's going slow, yours is definitely a better one, I think. But today's kind of the exception rather than the rule. And this is one of those ones, if you're a NASDAQ trader and you're looking for the trend trade, when these small triggers are strong, this is where I look for a close above them. This is where I don't take this trade until I get a close above the small triggers, because they behave as resistance, and you'll see it a lot. That's on the spreadsheet, guys, in the yellow section on the client trades. That's one of the biggest safeguards for NASDAQ trading, is never fight the small triggers. Because in most cases, they are the small triggers on the 13.2, which you wouldn't want to fight on any other chart, right? Look at that, stuck at resistance, guys. I don't think I'm even going to open up my NinjaTrader 8 and trade this afternoon. I'm going to go to the dog park. I'm going to go to the golf course. Something like that. Guys, that's it for me today. A lot of great lessons today. A lot of great feedback.